We'll do it live.
Okay. No.
We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.
Yeah.
All right, welcome back, guys. It's been a long time since we've done a live, and I thought we'd start it off with doing a portfolio update because it's been a really long time since we've done one, and there's a lot that's going on, within the portfolio, a lot that's going on, I guess, between the world, you know, all that jazz. And yeah, let's kick it off with pretty much the portfolio update. So let me share my screen. It should be pretty much the same. Same old. I don't know why sometimes the formatting gets... Oh, okay, hold on. What is this? Twidget active, waiting for chat. Well, the chat is active, sir. Let me see. Is this coming in? Okay, there we go. All right, so it is working. All right. Let me see. So Fabio's gains bragging about to start. No, we're not going to brag about the gains, but I think those will... I guess if people notice it, they notice it. But right off the bat, you can see that some of the positions have blown up, one in particular, more so than others. And as we've been kind of going through these portfolio updates, you've kind of been seeing how I've been reallocating capital here and there. So as far as kind of explaining the major changes, you guys know, I guess if you're part of the community, you know that I've sold some of my Salesforce. And then this Friday, I actually made out kind of like a bandit almost. Not really. It wasn't that much premium, but we sold some contracts on Salesforce expiring Friday at strike of 200. Remember, I don't normally do that, but in this case I did. Turned out okay. Either way, I'm very happy. And this is already on top of the amount of Salesforce that I've trimmed. So that one's come down. And trying to remember, you probably haven't noticed Amazon. If you have, good for you. Amazon is now a bit larger than it was before, and it's continuing to grow. So that is a position I'm continuing to allocate. Alphabet is getting smaller in allocation, and so is Netflix, only because Meta has grown a lot more. So I haven't sold any Alphabet or Netflix. It's just that Meta has kind of swallowed up a portion of my portfolio percentage on its own, just with its gains. And yeah, by the way, just want to highlight the gains I have on Alphabet of 145.72% there is out of many years of investing in Alphabet, while Meta hasn't even been in the portfolio for really, well, the lion's share hasn't been in there for really less than a year. So it's kind of crazy to think about it. But yeah, that's been doing pretty well. And then Netflix as well has been doing pretty well. Amazon, we will see how that one turns out, but it has been doing pretty well. So my cost basis has gone up because I've added to the position as it was continuing to go up. And we also, nothing's really changed with Murphy's. Salesforce, I've already told you, that one's been trimmed. Northrop Grumman's been staying the same. Catalent is a newer position from the last update. So this is one that we discussed from, if you guys are not members of the Sense Invest Club, then we've been talking about that one for a bit. It was an interesting opportunity to kind of get in there while Danaher really didn't really want to go through with the deal, turns out. So the stock price crashed. We'll talk a little bit more about that later. And if there's questions, by the way, that's what these live streams are for. So if you guys are new to this channel or you guys are coming back, that's what these live streams are for. You guys can ask questions. So I have a itinerary. Okay, I've organized myself this time, but I have space for answering questions. And again, you guys know I love to engage with you guys, and you know, we can have, well, I think sometimes I might stay on like way too long. I go like, oh, I'm only going to do this for like an hour and a half. End up like staying 3 hours. But anyways, so Catalent's new. Essex Property Trust. That's relatively new, but I think that was in the last portfolio update. I forget when the last portfolio update was because it's been so long. I believe, geez, I think it was in March. So it's been a while. And then Kilroy, nothing's happened to Kilroy. Digital Bridge, that one's been trimmed a little bit. And Perion has also been trimmed a little bit. So I took some profits off of Perry. Perry's actually pulled back a bit. So it was a bit higher. Now it's, it's coming down, but that's fine. But trimmed that one a little bit. Brookfield, I already made a video on Brookfield. If you haven't seen the Brookfield video, I posted it, I believe, what was it? The weekend or Monday, something like that. But that's a new position within the portfolio. It's a returning position. If you've been following the channel for a long time, you recognize Brookfield from portfolio updates of last year, and then now it's kind of made it back in. I'll get to precisely why that is, or remind everyone. CrowdStrike, nothing's happened there. 3M, nothing from Arkel. Humana, a new position. So Humana is an insurance company, health insurer specifically. I actually quite like this one. It always tends to look kind of on the expensive side. And I think, for example, where I'm kind of putting it in the portfolio as far as its allocation goes, it's a supporter position. I put actually core because it could end up being large, and that's kind of what the designation is for. I think some people always ask me, and I get this question a lot, well, what do you mean by core? Think of those as very loose terms of how I kind of think about them. It's not a rule. There's no rules here. It's pretty much, I mean, it's subject to change, and be a little bit more, fluid with that meaning, because ancillary could almost come out as core, and core sometimes can just stay as a supporter. But it's kind of showing you what I'm thinking about that position of its potential within my portfolio. Intel, I did trim this one a bit, and I'm actually thinking about trimming or actually getting off of all semis except for the other smaller position down at the bottom, which we'll get to in a second. But Intel, we've done quite well on that one. In this most recent, and if you guys have been following me for a while, every time we've gone into Intel, we've almost gotten lucky every time we saw. I'm not saying it's going to go down now, but I'm kind of just wanting to add allocation to other parts of the semiconductor space, or just allocate it to other names in general. So that's kind of why. It's not really any reason. They haven't done anything wrong. And LYB, nothing's happened there. Morgan Stanley, a newer position. So on this bank collapse, or series of banks collapsing, which we'll talk about, Morgan Stanley is one of them that I added. I added a little bit more to Wells Fargo. I added a little bit more to, I'm skipping now, but just want to get those out of the way. PacWest is speculation, and Truist Financial Corporation. Another one that's gone pretty much from the portfolio, and I've been trimming it down quite drastically. Or planning on trimming down quite drastically. It's better to say that, is Realty Income. So I sold some, but I'm going to plan to actually wipe it, and I'll explain why. There's a company that is replacing it. It's already actually larger than it, and that's Agree Realty. So I kind of skipped to Realty Income, but that's kind of the plan. So I'm actually saying in advance what that one's going to be doing. But so next week, that's going to be probably gone. And in favor, I'm going to dump all that into Agree Realty, or at least some of it. Agree Realty, what I like about it is its size relative to Realty Income, its strategy. They kind of fit almost the same mold within my portfolio, which is exposure to triple net lease. The fact that they pay monthly dividends doesn't matter to me. Although to some people it does matter, I don't really care. If anything, it adds more administrative strain to the business, but really kind of focusing my portfolio in terms of diversifying into a particular strategy, such as triple net lease, and Agree Realty, which is also run by the family, which, funny enough, the Agree family, is focused primarily on investment grade tenants, more so than Realty Income. Realty Income, I would never call them like a store capital strategy, where store capital would focus on non-investment grade tenants. Master lease agreements is what they would do. It gives them a lot of insight into the actual tenant's business. While Realty Income, Agree Realty, they're going to be focusing more so on the investment grade side. I believe off the top of my head, Realty Income's investment grade portfolio is about 60-something percent, 65%, let's call it. And then Agree Realty's is upwards of like 70-something percent. So I like the, let's say, conservatism by which Agree Realty plays. And I think they kind of play a similar strategy there. I could have thrown in NNN, National Retail Properties, in there, but I prefer Agree Realty for that. And I like the size. So I think that Agree Realty has more capability to find good deals, high quality deals, while Realty Income at their current size, I believe management said they're going to hunt for about $5 billion a year in deals. That doesn't mean they're going to buy, or I think they said they're going to buy. I forget, it's they're hunting for, and then they're going to look through those 5 billion, or that's how many they're going to buy. But if that's a dollar quantity of assets that they have to buy, it's going to be harder and harder and harder to keep the quality up. So fantastic company, fantastic REIT that has performed very, very, very well since its IPO. But just going forward, I don't really see it. So nothing's happened to Dropbox, still kind of there. Celanese, same thing, still kind of there. Tyson Foods, still the same. Activision has been trimmed. Not so much because of what's going on, and it wasn't a big trim, it was just a small trim. Boston Omaha, nothing's there. Cirrus Logic, this is the semiconductor stock that I'm going to be keeping. Not really doing much with that one, just keeping it there. And then Walt Disney, nothing's happened there. BASF, nothing's happened there. I already addressed PacWest. So that covers all of the updates on the core side. As far as the ancillary side, or not the ancillary side, the speculative side, I'll kind of go through with you guys what's happened here, and that's pretty much nothing. If anything, they just look a lot smaller than they did a little bit ago. Specifically, actually talking about Baba, just because of capital that's been deployed elsewhere, and with Baba, we did sell half of the position once it got to that $120 range where we said we would sell half of it. We're still having fun with that one, but that one's been a wild roller coaster. You guys know exactly how I feel about that. Okay, so the camera is blocking. I shall move myself. There we go. Some critical shark says, good morning. Thank you, sir. Fabio likes NVIDIA at any level. Yeah, I do. Okay, so Fabio, is there a point where you say there's too many stocks in one's portfolio? Do you feel it's easy to keep up with all these companies? Well, I'd say that if you kind of look at, and you see my portfolio at any given time, there's companies that I think I have to pay attention a lot to, and other companies that I don't really have to pay that much attention to. What I mean by that is, like, I should be paying attention to each and every company, and I do for the most part as much as possible. And I don't think you need to pay attention too much on the day-to-day of any business. If you're investing in those kinds of businesses where you're having to pay attention to the day by day and next news cycle, you might be investing in companies that are distressed to the point where they have like a make or break event. So I tend to not like those businesses, although I do involve myself here and there for either fun or maybe it's a legitimate investment. So, for example, I'll give you one that I am paying attention to. It is a speculative holding, but I still pay attention to it. Is MPW here with, it's actually, they're suing the reporting, not the reporting agency, the research firm that came out with the short report. So I'm paying attention to this one, even though it makes an insignificant part of my portfolio, but only because the news cycle, the updates actually matter for the longer term vision of the company. Because if what the accusations are true, if they're true, then the company is potentially might not be a going concern. Let's just say that. So the likes of Netflix, I don't really pay attention to. I did all the research that I could have possibly done. I might do like an annual update, a quarterly update, maybe if I feel like it, and see how my business is doing. And same with Alphabet. Amazon, I will be paying attention to what comes up in their quarterly reports. Seeing, I kind of have my let's say report card that I give to the company and say, okay, well, I expected this, and this from you. How are you doing on this, and this? And I give them my own grade. Again, it's not like a formal process where I have like a legit report card and give them the grade, and at the end I look at it. No, it's kind of just more relaxed than that. I went all into KRC, and now I'm down. My kids will never go to college now. Well, that's the problem going on. So if you had done that, which I know that's a joke, but funny joke though. You need to be very careful about allocation. So I'd say for a solid investor, this is what I guess is the consensus. A solid investor, a very, very good investor, can pick like 6 out of 10 investments that are going to do well. And then even then we have to measure it off of like timing. So you could be right, but maybe like your timing might be a bit off. And why are you trying to time it perfectly? I don't think that's fruitful, to say the least. So that's pretty much what I'll say with regards to allocating 100%. I know it's a joke, but if anyone here allocated 100%, you are basically making a statement that is either the bottom and you somehow know that, or you might have insider information. I don't know, or there's no other alternative possibly that could be better, possibly at all. And so you're making a statement at that point. I know that no one who watches me would do that. For the most part, I have somehow attracted very bright people. And then like a kind of a, let's say, gathering of the better sides of YouTube. Let's just say that. All right, we can give thoughts on KRC Q1 earnings thoughts. I thought that their commentary on being defensive is, warranted, given where we're at. And the office real estate space is going through their apocalyptic moment. I do think that, in my personal opinion, the A-class properties, they're going to do the best, but we'll have to wait and see. And so kind of investing now, you're still going to be pretty early. I mean, evidently you are pretty early. So the likes of Brookfield actually could benefit really strongly here. They have a lot of capital sitting on the sidelines that they would like to deploy. They do engage in office real estate purchases here and there. Now, we are seeing companies that own C-class, B-class properties. They seemingly are going to go under. More recently, there's been a short report come out for Vornado VNO, kind of stating as such that they believe the company will go under. And that's going to be interesting for a variety of reasons, because how that expands into the financial sector, which we'll get to that with the banks. But there's one bank that I haven't added yet, but I really wanted to add here, and I didn't get to it. I put an order in, but it didn't execute, and I thought it executed, and that was for US Bank. I'll explain that one in a second, why I like it. I thought I was going to do my own video, but yeah, I was disappointed to see that it did not execute. So let's see. When you looked at Alphabet's Q1 this year, what were your thoughts, Fabio? So my thoughts on Alphabet's quarterly report, and let's go ahead and put Alphabet's stock price here. So GOOGL. And I thought, well, for one, and I also took a little gander this morning on CNBC's clips or whatever with Oswath coming in and this other guy. But the commentary is kind of interesting, talking about how they're looking at the quality of earnings of these tech companies. And because Alphabet has changed the way they depreciate the servers, that their earnings quality has therefore decreased, because they view it as Alphabet is fudging around in the accounting to make the numbers look a little bit better. Now, I get that point. And one thing I'll say is, okay, we saw, YouTube ad revenues coming down, but from the other side of things, we did see that there were some increased revenues from their category that is where YouTube Red or YouTube Premium is included. So what it goes to show is that's a more valuable side that people aren't really paying attention to. Google Cloud posted a profit, so that's positive. And the remaining amount, like for example, concerns of market share with ChatGPT and all that, it still hasn't really shown itself just yet. So Alphabet, while I bullish on Alphabet and all that. I think it's a fantastic company and, all yada, yada, yada. I'm much more bullish on Amazon, but we'll get to that. So Alphabet has a lot of things going for it, and it's, I think, appropriately priced at the moment. I think that someone could make an argument, and I said this in the Sense call on Thursday, but the value in Alphabet, I can see why someone would make the argument that right here is a good buy, or why most times it's a good buy. Let's take a look at, for example, the 5-year. So you had this, the craziness, now the pullback. So I think this is warranted because growth rates out into the future have come down. While back then, and if I had a crystal ball and we were back in 2021, where when I thought Amazon got way ahead of its skis, I would have sold also Google, because clearly Google, we could have, timed it, but that's not how things work, right? And so I held Google throughout this whole period, which it is what it is, but it's still fine. It's still fine. So with Alphabet, what market's kind of saying here is, yeah, well, growth rates have come down, and therefore we're going to price that accordingly. It makes sense. I actually agree with it here. The multiple isn't extremely cheap. We got to keep in mind, though. Let's talk about this in comparison to like a Meta opportunity. This is no Meta opportunity by far from it. So Meta at the time, when we saw the absolute collapse and we saw sentiment hit rock bottom, essentially, where it's kind of funny how quickly people change their minds, we saw that the multiple you were getting for Meta's earnings on a normalized basis, was, I think, what, like a 10? A 12, a 10, something like that. I forget precisely where it got to, but it got really low. So you didn't have to actually pencil in that much growth at all for the valuation to make sense, for you to kind of say, okay, this is a business I want to be involved in. And clearly that wasn't what the narrative was about. It wasn't at all about, how profitable can Instagram be, WhatsApp be. It wasn't about that. It was about how much money are they burning on the metaverse, et cetera. So Alphabet, where you had 2021, let's go back to Alphabet here, where growth was, up and through the roof, et cetera. Everyone's at work from home. Advertising revenue online is great, blah, 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 blah. And I think they posted like 20% plus growth, et cetera, back then. And by the way, the years before that, they've been posting like 20+% growth for a long time. Well, now growth rates are expected to come low double digits. Oh my gosh, low double-digit growth. And so therefore market reprices it. It still gets a bit of a premium, don't get me wrong. And that's the point. It's still a bit of a premium because the market isn't that pessimistic about Alphabet, right? So you could make a good argument that Alphabet is a good value because it's going to maintain its premium and it's going to continue to grow. And then you should do fairly well. All right. So where I'm at is I'll just hold my position out into the future. And that's it. We're good to go. Where someone who's kind of saying, okay, well, I want to build a position in Alphabet. Well, you got to look at your alternatives and, make a reasonable assumption about if you are, let's say, comfortable with that alternative that you want to invest in, et cetera. So that's my thing with Alphabet. So quarterly report, I thought it was good. I understand the concerns about the accounting change and all that, and why you might disagree or hope they didn't do that or feel like they're trying to deceive you, et cetera. I get all that. I get the valuation argument here. It's not cheap, right, on an absolute basis, but on a relative basis, it's decent. It's a decent value for the business that you're getting. That's all I'll say. Okay, so let's see some other. Okay, well, I want to actually get to the topics because I said I had an itinerary for today, and we got the Q&A. We're going to get to the Q&A. So itinerary for today, we're going to talk about First Republic. So let's actually pull that story up. I'm going to take this tab and go over here and find the story, but let's see here for. Okay, so we have it. I wanted to talk about this one. All right, so here, we got this one from Bloomberg. So Bloomberg article here says, FDIC asked banks for final First Republic bids due Sunday. So if you don't remember, it was Citizens Bank that actually acquired the assets of, I think, Silicon Valley, not the other one. But anyways, when you have a bank that's going into failure, like First Republic, some of these other banks, it's particularly, I think it's JP Morgan, which is listed there. And the other one was, I think, PNC. So PNC was also making a bid or efforts to bid for First Republic. They're going to come out as the winners. And if you guys remember, we were having fun in trading FRC. And that did not turn out well. Okay. Turned out very poorly. I think some members did fantastic. I know of two that did fantastic. And I should have listened to them. We should have followed their lead. But my gander here was absolutely abysmal, if anything. But I thought, Bruno, by the way, I saw you. I thought I answered the question for KRC Q1 earnings thoughts earlier. But let me know if you have a specific question about it. All right, so. I don't know if wait, is this not updating anymore? It might be that the app thing is not updating. That's unfortunate if it's not. Yeah, it's not updating. Okay, so never mind. Forget what I said. It just made it look like you said it again. Okay, apologies for that. Let me just close this out and then restart it because it does this. That's the unfortunate side of using these widgets. They're not built in automatically, and you're kind of just manually having to do things yourself like that. Okay. So anyways, so what we see here is we have a couple banks that are coming together. I think that if JP Morgan Chase gets it, that will be fantastic. I mean, tip my hat, because what you have at First Republic is not a credit issue. You don't have a credit issue. And I think if you watch the live stream, I said all hands on deck. It's titled All Hands on Deck. It's like over an hour. And in there, I talk about the situation kind of as it was happening. And I talked about First Republic's balance sheet, right? And the thing with First Republic is their balance sheet had among the lowest credit risk of any bank out there. And that still remains today. So when you have this bank failing, now you, as any bank, has the opportunity to purchase these assets at pennies on the dollar. And if you know that there isn't very much credit risk, then why on earth would you pass up on that offer? As long as you don't have liquidity issues, and fun fact about JP Morgan Chase, the average duration on their balance sheet is, I think, among the lowest of all the banks. It's like 5 point something years. Let's call it 6 years. So 6 years, that's ridiculous. Okay. And then for some extra context, US Bank has, I think, about a 9-year, which is also crazy. Like Bank of America and Wells Fargo, they have very long durations. They're banks that love to buy these assets and just park it in the balance sheet and hold it to maturity. Now, if you're looking at First Republic and you don't have these liquidity issues, why on earth would you pass up on it? Why would you not make a bid and try to get those assets? Because you don't have liquidity issues. You're completely fine on that front. And then you have the opportunity to buy assets that are going to pay out if you just hold them. And you buy them for a discount, which is, good idea. So we'll see who ends up getting it tomorrow. We'll see according to this. I'm thinking it's going to be JP Morgan, because JP Morgan, I mean, they have the best ability to absorb it. The only reason why they might not get it is political reasons. So that's the only reason why I would see them not getting it, because, let's see what the other guys bid, because at the end of the day, the other guys might want to bid even higher for it. Who knows? So they might lose on that front. Okay. I think the widget is broken again because it hasn't updated. I'm going to probably have to stop using this widget. But I need the widget only for the purposes of making sure I can put people's comments up. So let's see, go through this. What are the reasons Google does not commercialize its chatbot? Why do you think they are being slow with releasing it? To be honest, maybe because it's not that good. Let's not sugarcoat it. Maybe it's because it's not that good. So yeah, the ChatGPT version 4 is pretty good from my interactions with it. It's pretty good, and it can do a lot. So there's a lot of potential it can do to help someone else. But anyways, good question though. So closing off with this topic here. I want to say this kind of coincides with the liquidity crunch, which liquidity crunch aside is kind of more or less the reason why we positioned ourselves the way we did last year. And this is kind of like an unforeseen sudden consequence of it. I mean, now a lot of people are talking about liquidity crisis, et cetera. And I think that's now very forefront in the media, way more than it was at the tail end of last year. So if we're kind of looking at treasury markets or treasury auctions, we're seeing them go well below the rates that they should be at. That kind of shows us that a lot of banks, a lot of financial institutions are clamoring for collateral. Because remember, the treasury market, treasuries themselves are a tool as much as they are as an investment. If sometimes you're looking at it and you're right, it doesn't make sense from the investing standpoint to just pay for such low yield. It's because, right, they're tools as much as they are investments. So that's kind of concerning, because that's banking institutions voting with their dollars. They're basically acting and behaving in a way that is panicky, even though verbally the CEOs might be saying everything's fine. There's nothing, no recession whatsoever, blah, 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 blah. And when they're just going out and just behaving in a completely different way. So That's that. Now let's talk about Amazon's earnings report. So Amazon reported earnings, and they actually came out with pretty strong earnings, from my personal opinion, right? And the market thought so too. And I think the community made a joke. As soon as Jassy opened his mouth, the stock tanked. Now, cloud AWS came in a little bit lower, right, in terms of forward guidance than Azure. But you got to keep in mind, actually, when I looked into it a little bit more, it made sense. Azure had a short-term boost from the, let's say, AI stage, right? ChatGPT and all that jazz. But also keep in mind that AWS has a little bit of a handicap because a lot of their exposure is in the startup space. They have a huge exposure in the startup space. So it makes sense that the following couple quarters projections are lower. Now, as soon as we start to see kind of the other end of this economic downturn, basically into the next resurgence, which I do think we're going to have, I'm more of an optimist. If you disagree with me there, okay, we can have that discussion. But Amazon on the other side of this, I think AWS is still the leader in cloud, and for very good reasons. Azure is going to be great. There's still going to be two. There's going to be a Pepsi to a Coke, and that's how I see the cloud market for now. And the other side of things is advertising. Advertising grew in a quarter where advertising isn't supposed to grow that much. So that's the highlight, actually, because I saw members of the community actually saying, well, did it really grow that much, right? So what's the story? Because I did a write-up for members last year. And in that write-up, I showcased, like, for example, prices I'm interested in buying Amazon at, et cetera. And funny enough, it got to that point, but I was restricted from purchasing it at that time. And the big part of the thesis was the two businesses, well, the three businesses that I'm looking at, but the two main ones that I'm focusing on, which is advertising and cloud. And that I say those are the two most important businesses for Amazon. So advertising in an era where advertising doesn't generally grow too much, it grew quite nicely. And I still believe, and I maintain this, that Amazon advertising will be larger than Meta is currently in, let's say, I think 5 years. Easily, I think 5 years. So I think that you need to be more cognizant about what quarter we're in. And so really what I'd be paying attention to is the next quarters, the next couple quarters, how Amazon advertising does. But already that they grew in this quarter was quite impressive. And then that will segue us into Meta, but kind of finishing us off on Amazon. I think that there's a lot of levers that they still have yet to pull, or that they are pulling, but still people don't realize that they're pulling. And focusing on CapEx spending, because they are a free cash flow machine when they want to be. CapEx spending will probably reduce in the next couple years, or quarters even. And then once that starts to happen, you can see the cash start ramping up. I want to remind everyone that you remember the Salesforce pitch, right? Salesforce, we're scaling out in the portfolio. We're not selling completely, but we're scaling down the position because it never was meant to be this huge position. But Salesforce was a very similar theme where we invested in Salesforce and we're kind of everyone forgetting or maybe not giving it enough credit for where credit is due, that those kinds of companies can produce absolutely crazy amounts of cash flow when they want to. And once Salesforce started to show that and remind everyone, then the market repriced it in excess of what the broader market repriced at. Okay, so that's kind of an indication of that short-term outperformance that we saw was the market. So some of that was market movement, and then the excess was what the market was giving it in terms of a premium in excess of the market movement. So that reward for Salesforce can very much happen in Amazon in the near, medium, short term. Once people kind of remember what's going on under the hood, okay? But it can take time. It can take time. So I'm perfectly willing and hoping, actually, I kind of, the scenario for me that's good is if actually we get a pullback on Amazon, because then I can actually build it out a little bit more. Very same thing that happened to other businesses we acquired. I want those great prices. I don't want it to run away at this point. I'll make more money being right longer term if in the shorter term the market kind of gives me those opportunities to accumulate, and I still have cash coming in that I can deploy. And I'm getting the cash from the sales that I have and kind of redeploying it into these other names. So that's what we're doing. We're reshuffling, recycling the cash. So let's see here. Meta bags pump. Fuhat, too many messages all at once. I'm going to have to put like a slowdown mode on you. Let's see here. But okay, well, I want to talk about Meta, but there's another business I want to actually start accumulating even more. What's the best company for steroids to make a person look lean? I don't know about that, but let's see here. May I ask, why do you think that Amazon advertising will be this huge, Fabio? Well, M. Laden BG, if you think about it, with Amazon advertising is perhaps the most valuable form of advertising that exists currently, because when I've explained this analogy, but I go on Amazon and I say, I did this the other day. I bought a pull-up bar. I want a pull-up bar. So Amazon then now automatically knows, okay, I'm a person that wants to spend money. What I want to spend money on, I want to spend money on a pull-up bar. And so the other category, by the way, and I forgot to mention this, that I'm grading Amazon. This is also in my write-up, where I talk about observing Amazon's transition from first to third party, okay? And what we noticed in the last quarter was the transition is going along smoothly. It's happening, and it's going to continue to happen, and I'm going to be watching them across time to see how that happens. But I go on Amazon, and I say, hey, I want a pull-up bar, and Amazon goes, okay, this guy wants a pull-up bar, and then all the pull-up bar sellers are like, I want to be in front of that guy because he wants to buy a pull-up bar. And so I look at, the first top ones, and the ones that Amazon recommends to me at the top are sponsored, or they're paying to be up higher than the other ones so that they can produce the sale. And at the end of the day, that does work more often than not. So I look at the top selection that Amazon provided to me, and I purchased one of them. That's it. But when you kind of think about it from there, you have Meta, and Meta's algorithms are trying to understand you so that they can try to understand what you might want. Okay, so you're looking up on something, you look up best pull-up bars or whatever, and then you might get an advertisement on Instagram for pull-up bars, right? And so it will navigate you to a place where you can buy the pull-up bar. While Amazon's is like, you're ready to go, all right? You're ready to go. So if I'm willing to pay the advertising for Meta or for Amazon, I'm probably going to pay more for that Amazon advertisement than I will for that Instagram advertisement, because I can get right in front of a person that wants to buy the product that I'm selling, right? Makes sense. So I'm oversimplifying advertisement, but it's a way that is simplified enough that someone can, I hope, understand the analogy or the example. What is my fair value for Amazon? I'm answering questions on Amazon, by the way, because we do have a broad Q&A section to come. But I don't have a price target for Amazon. I think if you look at, I don't know, like Bank of America has like 134, price target. I have a values that I am willing to buy, and I don't really have a price that I'm gonna, think about selling at this point in time. But I'd say that I wouldn't buy Amazon if you think about that as being fair value at 140 or something. I wouldn't be buying Amazon. The valuation would be too gross for me. But at these levels, I think it's decent. And then my true values where I thought it was really good. And Ricky, I know you have access to the write up. Just go to the write up and see it. But it's I think it was like 80s, right? Something like that. And where it got to, but it is what it is. So let's see here. How many pull-ups can you do? So I can do, in my prime, I could do like 20 something. Right now I could probably do, because I am heavier. And so I probably do like 13, 14, 15 around there. So what I'll do, we did a Discord call, and I was at the gym with the Discord members and was doing the pull-up sessions. Shout out if you guys were on that call. But yeah, I'll do, for pull-ups, I like to do a lot of pull-ups. I think they're one of the best exercises. Compound movement, gets you used to your body weight. And yeah, no, it's a good workout. Let's see here. Do you like BIP. Yeah, love pull-ups, Ricky. I love the enthusiasm. I love pull-ups too. Okay, so do you like BIP or BEP, or are all you love is BAM? Yeah, I don't like their entities. For me, I want to buy either BAM or BN, and I'm going to go with BN. But BAM, keep in mind, BAM is going to be that high cash flow, or sorry, high cash cow business. They're going to pay out a lot in dividends, and that's the vehicle. How does it feel to be performing better than most money managers on Earth Capital Mindset? It feels good, but also, you know, sucks to suck for them. And I'll make money outside of that, and then, you know, manage my own money and no stress. I have no stress because it's my money. Let's see here. Do you need to core strength for pull-ups as well? Oh yeah, you do. You can develop your core, especially if you kind of lean a little bit forward while you're doing that pull-up, kind of legs up. You actually do develop more core as well. Anyways, it's not like a workout channel, but, you know, good to incorporate that stuff. As well as, you know, on Discord, we have that cooking and fitness channel where we share like cooking and stuff. And yeah. All right. So I bought FRC at $6. Well, it can't go any lower than $1, right? You know, that old adage. So I know BFI is only for fun and I never bought it, but is the new lawsuit fair in your mind? Probably not, and I didn't pay attention to it. So BurgerFi, Steve, that's a great question. BurgerFi is an example of a company I literally do not even look at, because it was a fun stock. I have it, and when I was accumulating shares back in the day, it was the spare change from every purchase. So I was like, all right, I bought, you know, an investment. I had like $5 left over from what I wanted to buy. I'm like, all right, throw it in there. All right, throw that in there, and then, you know, it's like, it's probably gonna go bankrupt, but it's kind of just for giggles. Look, he appreciate how the community a ton taught me a lot better, more rational investor. Yeah, no, absolutely, Ricky. So, I mean, I'm really happy to see that you and others get value from the community. I'm very proud of the CM community. I think that the CM community really built out in such a way that I'd never predicted. I haven't seen other communities build out that way. I think the testament is to how slow and curtailed the growth has been. And I think if you kind of put your I don't know how to say, but like good intentions forward, the people who see that then kind of come forward, and you get surrounded by people with good intentions as well. So I think that's kind of like the secret. It's not really a secret to success in terms of building a strong community. All right. So let's see here. Plus we're all index performers. Why doesn't Sensiano post videos anymore? Well, that's because the main guy is actually doing a lot of other business. Let's see here. Sued Raffle. Okay, so anyways. Fabio gives detailed personal financial advice on the Discord. Absolutely. That's completely true. Actually, I ask everyone who comes in, I'm like, all right, what are all your individual secrets? And then I give them personalized financial advice. And I charge them $1,000 for it. Anyways. Let's kind of get to the second adage, or the second part, but Meta. Right, I wanted to talk about Meta's earnings, because Meta reported, and Meta's as you can see, a huge part of the portfolio. So keep in mind, I also want to let everyone know this as well. But members who get to see it, I have, this is my personal holdings, and then I have a holding company that I built from scratch. Right, I built the portfolio from scratch, and it was a completely new portfolio last year, and it answered the question early on, hey, if you were to start all over, right? You didn't have Alphabet, you didn't have some of these other legacy businesses. What would you invest in? And that's what that portfolio has been answering. So it's existed. It's younger than the YouTube channel, but it's existed for almost as much time as the YouTube channel. I'd say 2022, late 2021. And so I put a monthly amount, and I showcase the entirety of things. So here I'm more private in terms of like dollar amounts, but there that they get to see the whole enchilada there. But for the most part, they follow like relatively the same strategies in like the present. It just doesn't have, again, legacy positions. But Meta in there is a very large position as well. So point being, Meta is very significant. Okay. And so Meta's earnings, of course, I have to pay attention to, right? Because Meta is so large, and Meta at this point has recovered so fast. It's kind of like just wow. And I am at the point where if I were to sell, the tax consequences would be very drastic. And I have a portion within a retirement account, but the lion's share is outside of a retirement account, because retirement accounts are great and all, but you're very limited in how much you can put in a year. And at some point you can't put any more in, which kind of sucks. But that's the way things go. But the part that is in that retirement account, still I haven't sold it, but that's the one I'd sell if anything. And I have to wait quite a bit of time before it becomes long-term capital gains. And that matters, at least in this case. So yeah, let's watch Meta just go to 300. Meta goes to 300, I'm retiring. I'm not even joking. I'm done. But I'm joking. I'm not retiring, but it would be tempting. So yeah, with Meta Platforms, it was a good quarter. They really what was strong. People were freaking out because the numbers weren't good, right? Because but keep in mind, I just talked about it with Amazon advertising, that this was a poor quarter in general for advertising, right? So this is not the quarter that you pay attention to. This is the quarter that you go, the numbers are going to be bad, right? But what people saw, what the market saw, or what the market was very proud of, was the engagement. So engagement across platforms was pretty strong. The monetization of WhatsApp keeps coming along strongly. Investment in AI, same thing. I will talk about something that made me even more bullish than before. So, Jesse, great question. So actually, I'll come back to Meta. I'll answer this question because it does pertain to a previous topic. What will happen to the shareholders of FRC if JP Morgan and another bank purchase FRC? So it's the same thing I said in the Sense call. They're going to get wiped out. Equity holders will get wiped out. And so I think it was 3 weeks ago, back when I was still in Florida, we had the Sense Thursday calls, and it's essentially a live stream where what we do for the members. And that was part of the topic. And my statement there is basically what is going to happen now, right? The movie has played itself, and it is happening, that equity holders are going to get wiped out. So it was kind of the question was brought up, okay, well, you had a small speculation fund, whatever, in FRC. Why did you sell if it's just speculating fund? Because at the end of the day, if I have a very strong belief it's going to go to zero, I'm not going to just lose money for fun like that. I'm not about that. Okay, there's limits, everyone. But the reason for selling FRC was because I was, at that point saying, yeah, okay, equity's probably going to get wiped out. And this was back when, the bank was getting liquidity, about $30 billion from the larger banks. There was some optimism right around it, but in reality, it was not enough. And at the end of the day, when you even saw the investment bankers coming forth and trying to make a negotiation with some banks, that was enough for you to kind of go, they're probably effed. And they were effed. So it's really a shame because, like I said, I repeat it one more time, the quality of this bank is top-notch quality bank, just susceptible to a bank run like everybody else. And what will happen if JP Morgan buys them? The current equity holders are wiped out. That's part of the game. Okay, so hopefully that answers your question, Jesse. Yeah. No way around it. Okay, back to Meta. So engagement's up, great. What does that mean? Well, advertisers are going to look and say, oh, people are engaging it more. A lot of people, I think the number of reels shared went from 1 billion to 2 billion, which is crazy. And you continue to see the benefit of building your own infrastructure, something that TikTok can't do because it can't afford to do it, but Meta can. And also, let's talk about something that I am actually a bit more bullish on now, right? This whole gimmick of AI and all that is all well and good, but when I see Snapchat, right, coming out with their AI, which is off of the ChatGPT, which they're going to be paying for, and they're already losing money, and they're already just a terrible company in general. When we start to see I guess that engagement, and I'm seeing it now, that engagement from the user base actually using the product, right? I'm saying, oh, there's nothing stopping, Meta from actually doing that and deploying something like that for their customers, for their business end users, et cetera, and all that. And that's actually what Mark Zuckerberg was talking about. So before I, kind of almost thought, oh, AI is only going to be used to kind of figure out what's the best thing to advertise to who. But now I'm saying, well, no, there's actually a case here that Meta could use their infrastructure that they've built out themselves, and that therefore they control the gas fees there for themselves, and provide a similar product to increase and improve engagement. So, you know, you can have your own assistant now on like Instagram, right? Because it's going to be commoditized, but like now on Instagram, I'll have it and it's fine. I can ask it to do certain things for me and it will do it. Search function, all that jazz. So I think that's, you know, just interesting. Another little thing that they can do in the future. But really the main important thing is what are the B2B solutions they're going to be offering. I hope that everyone now sees what I was talking about in those videos. Okay. If you don't know, I hate doing that, but I might do it just because there's newer subscribers and all that, and that's fine. But the videos that I made on Meta, I think are still valuable today because nothing's really changed. And that's a good part about it when you do research. If you do the research right, it should last a little bit. At least, you know, because I love these YouTube channels that dedicate every single day to like a certain stock. And I know like it works well for content, right? Because you get these cults around the stock. Imagine if I did that with Meta, especially with my Meta gains, right? So that would be like the optimal thing to do as a content creator. Okay, I did well in Meta. Now I should only make Meta videos and then build a cult around Meta and then just make Meta content every single day and talk about it every single freaking day. That would be boring. I would be so bored. I'd hate my life making videos. So I refuse to do it. So the Meta video I made like months ago in November, I'd say I'll just tell people if I can, just go watch that, right? Because nothing's changed, right? But you know, maybe I do have to make one. I think people have asked, but maybe I'll make like kind of like an update of sorts to it. But yeah, for the most part, the stuff I said in there hasn't changed in terms of what Meta is focusing on. I think just now people are paying attention to it more. Because I see people talk about it more. They're B2B solutions. How Meta as a business, right? People are focusing so much on the B2C, but the B2B is going to be the lion's share of where all the profits come from. Okay. And yeah, that's going to happen. So I was shocked when Don Fabio didn't know who Jerry Springer was. Yeah, I didn't know who he was. Fabio, pull up the C-suite and tell me they aren't teenagers. No, I believe you. Yeah, it does feel that way with Snapchat. It does feel that way. I see no ALSN here, Fabio. What's up with that? I don't see what's up with that. You want me to buy ALSN? I forgot what ALSN is. Allison Transmission Holdings. Oh, that's this one. Yeah, well, I never got to it. But this is solid business. Wow, it's up 7%. So those of you who did buy, I think you've done well. Yeah, you guys have done well. I messed out on this. As a community, it was like a community buy. Great to have you back, Fabio. Hope all is well. All is well, Bashar. Good to see you again. Okay, so Snapchat, when, Fabio? No, not for me. All right, let's see. So I think that's pretty much, right, all the topics I wanted to cover. Yeah, that's all the topics I wanted to cover. Pull up Rick stock. All right, we'll pull up Rick stock. Okay, so Rick. Yeah. It's a small little pullback here. Might be a good time. I don't know. I have Rick as the fun speculative holding, but yeah. Okay, so BN. You want me to talk about BN? Well, yeah, BN's a business that I'm coming back with. I like Brookfield. I think that thing with BN. I think how much does he have? Monish Pabrai has a decent chunk in BAM. And BN, but Pebblebrook, turn on dark mode. I don't have dark mode on Google Finance. Doesn't have dark mode. I have dark mode on normal Google. If you don't believe me, check this out. So see, I do have dark mode. It's just, when you go on Google Finance, it goes to light mode. Yeah, Google Finance does. Oh, well, I'll do that at some other point. I'll go into the settings and stuff and do that. Target allocation for BNs. Yeah, for Brookfield, I think my target allocation is going to be probably around the 4%. So yeah, Pebblebrook. Okay, yeah, we can talk about that. The one that someone just actually put in, I will not talk about that stock because that is a nano cap, but that's all I'll say about that. So Pebblebrook, PEB. So he's asking, I think, because Italian Jason knows I have a holding in this business, but you guys don't. We guys see it here. And the reason why is because I don't have the common stock. So keep in mind that from the get-go, the policy for the YouTube portfolio is no derivatives and just common stock, just strictly common stock, keeping it simple. But there were products, and I do talk about them in the live stream. So for example, 2022, we held a product, otherwise ticker symbol TTT, and we generated some good gains for that. Helped us kind of mitigate a lot of the volatility last year, kind of betting against treasuries. And then we had some dabbles in the tail end of last year with TMF for fun a little bit, the evil twin of TTT. And then kind of here also looking at the preferred shares of Pebblebrook that I hold, but they are not material. So I do have some preferred stock investments, but they are immaterial to the larger scheme of things. And in the holding company, where the members do get to see like the full portfolio dollar amounts and everything, that one is only common stock, right? So it doesn't even have preferreds. But I have a place for preferreds, and I'll kind of talk about preferreds because that's again what these videos and live streams are for. So actually, good thing you brought it up, Italian Jason, or Italia Jason. So the thing about preferreds is it almost changes the type of analysis you're doing, right? Because you're not looking at common stock anymore. You're not looking at equity. You're looking at debt, a debt instrument. And similar to bonds, you're going to be paying attention to liquidity of said business. How likely are they to pay you back? And then within the preferreds, you have a whole, same in bonds, by the way, but you have a whole bunch of different types, right? You have convertible, non-convertible, cumulative, non-cumulative. So what I purchased in PEB is the cumulative preferred bonds. And the redemption price, let's just say, is $25. What that means is if they wanted to buy back the bond, or sorry, not the bonds, the preferreds from me, they wanted to remove the debt from their balance sheet, they have to buy it off of me for $25. I purchased it for about $17-ish dollars. And so I got a pretty good yield on them. This was Q4 2022. And in doing so, what I'm doing is purchasing perpetual income. And that's how I view it. It's purchasing perpetual income. The tax consequences is going to be treated as an ordinary income. And what I get with the cumulative preferred is if they cannot pay their shareholders until they make me whole. Meaning, so if they don't pay me 1 year, before they pay their shareholders anything, they have to pay everything that is owed to me. So whatever is accumulated over that time period that they weren't paying. So that's the benefit of preferred. Typically, cumulative preferred should trade at a premium to non-cumulative preferreds because non-cumulative preferreds, just like the name, doesn't accumulate, right? So if they don't pay you that year, you don't get paid at all, right? They don't owe you the next year the amount they didn't pay you. It's not like a guarantee. They're not stating that that's a guarantee. So I prefer cumulative preferreds. And you'll notice that companies in the best credit situations don't have cumulative preferreds. They have instead, a lot of them have non-cumulative preferreds. Okay, and you see that there's some popularity among banking exposure to buy the preferreds, right? There's like a common thought that you want exposure to banks and their profits, but you don't want some of the risk of the commons, so you go with the preferreds, and then you kind of switch back and forth. Some banker investors do that, but kind of focusing on the bad side of preferreds is that you don't get much of the upside. So investing in preferreds can be a bit problematic, or if you're doing it the wrong way, which is why I don't encourage it. I actually think that before you dabble into preferreds, wait till you have a huge portfolio or a big enough portfolio that you can kind of make the justification. Worry about your core before you focus on all this other, fancier stuff. Let's call it fancier stuff. So, and I say the same thing about getting into options. If you're just getting started, you do what you want, but this is kind of like my opinion as it stands today. It could change in the future, but my opinion, if you're kind of just getting started with your portfolio, focus on building out your core first, whether that's just building out an index fund, a huge position in an index fund, get that nice size. And then when you're comfortable, then start putting a percentage of your new income coming into stocks. And then when you're comfortable with that, then you can start to learn maybe derivative. Maybe you never get there, and that's perfectly fine. You'll be plenty rich if you consistently invest and you never touched options, like you'll be fine. And preferreds, like you'll be totally fine. But anyways, going back to preferreds, if you do it the wrong way, and for example, you buy above redemption, you don't know what you're doing, you're going to be susceptible, and keep this in mind, to interest rates. So with preferreds, if you buy a high quality preferred, and you kind of make that, let's say, investment, you think, oh, I'm getting something that's super safe, et cetera. I'm at the higher end of the totem pole in terms of who gets cleared out when the company goes bankrupt. Yeah, that's all true. But you're going to not get much of the upside, right? Because of the commons appreciate because the company recovers, and you kind of bought it at, I'm making up numbers here, like $26 a share for the preferreds. You're not going to get that same level of appreciation. You're going to feel like you missed out, et cetera. And that's why Ben Graham hated the preferreds, because you don't get much of the upside and you don't really get the protection of bonds, right? So there is a sweet spot for preferreds. And I think most people who get involved in preferreds make the mistake of not, addressing the sweet spot. So I say, yeah, just, why get involved? And I'll say, like, most of the time, I don't like preferreds. most of the time, I don't like preferreds. In fact, I know that the community went into an investment with energy transfer preferreds, and that one turned out really well. And I think those are almost basically at redemption value of $25 a share, and they were purchasing it at below $20 a share. So when you take into account also the risk-adjusted returns, because again, it is at the end of the day, the preferreds, not the commons, it's pretty good. But yeah. Let's see here. Oh, I didn't even know that there was something going on here. That was funny stuff. Oh yeah, Bacon. So Bacon ousted him. So Bacon was the one who actually, I think it was Bacon and McBuda who were the ones actually proposing it. I never got into it, but they were proposing it to everyone, kind of like just sharing the idea. And it was really good. It turned out really well. It's because energy transfer preferreds, LO. Nice, never touching options or preferreds. Yeah, exactly. And Kingdom, you're gonna do plenty fine. Never touching them. Plenty fine. Okay, so let's see. Yeah, Google Finance. Any questions? Oh, DPSI. You're welcome, Dennis. Thoughts on Zscaler? No opinion on Zscaler. I haven't ever looked at them. Fabio, why don't you like Brookfield entities? Because I'd prefer just to invest in the mothership. It's not that there's anything bad with them. You are paying some management fees in those entities to the mothership. And so with the mothership, I get in direct exposure, yes, and also the indirect exposure, indirect economic benefit via the management fees and all that. So Ricky, I'd actually... without doing any further research, by the way, for the question on Zscaler, Trent, I'd actually pay attention to Ricky's opinion there. So for unknown reasons, just I'd look at that. Good to see Humira added. I've been adding it, and UNH. Yeah, both are solid companies. I like Humira, not Humira. Oh my God, Humana. Ugh, Freudian slip. Because I'm thinking of AbbVie. So yeah, by the way, you see there, Ricky says no go, all right? Again, just not, no context as to why his opinion is actually good on this, but I'd actually value his opinion here. So, so I'm deferring to Ricky, but because I haven't looked at it, but Ricky, if he's not, yeah, you see, trust me. Okay, no, I trust you, Ricky. I trust you. But yeah, oh, you added HUM. Yes, Kingdom. I added HUM. I added a sizable position, 1%ish. But Humana, solid business there, solid size for its industry, very high quality, good returns, not in terms of stock price, but compounding internally from the business, good risk management from the team. So I liked it, added it. You're going to be paying up for that quality. I'll wait if we get some pullback there. I've had some other insurers in the past within the portfolio. The most recent one being Unum Group, which you did really well. That was a distressed equity that we bought back in 2020. Turned out well. You guys who've been with the channel for a while remember that one. But yeah, well, when are you going to buy DRBG? Digital Bridge? I already did buy Digital Bridge, Fuhat. Someone does not pay attention. Fabio, Digital Bridge, when? Fuhat, it's been in the portfolio for a while. Someone has not watched the videos. What are you doing when these live streams happen? Fuhat's a fake fan. Absolutely, Fuhat. Come on, man. Oh, when am I doing a video on Digital Bridge? I don't know. Maybe one day. It's a digital bridge too far. Yeah, that's a good one. All right. ELV the GOAT, bruh. All right. So Kingdom of Finance actually likes Evalance, I think is the name, which it's a good business. Don't get me wrong. It's a good business. I like, when I looked at all of it, I liked Humana just a little bit more. And I will say I did actually, not within my holdings or portfolio, I did add a little bit of ELV to a family member's portfolio. I did do that, but that's about it. It's small. It's nothing meaningful. Fabio, he's like watching it. Fabio, Jason, what's up, Jason? How you doing, Jason? You got my attention, Jason. ELV has limited growth prospects. Yeah, that's kind of like my thought on ELV. But with that portfolio addition to that family member, I added also Humana at a larger size. But I liked both businesses because I think we were talking about ELV. I think that ELV, it's more like a watcher, and then if I get a good value on ELV, I wouldn't be opposed to accumulate. So within my portfolio, I don't hold any, but I'll be watching it, and I'll be watching it via proxy, I guess you could say. Did Jason get banned? Okay, so I'm watching ICE. So ICE, actually, I had a decision to buy it, and then I kind of pulled the trigger on it. So I didn't include it in past sales because I didn't even own it for like that long. But ICE, I am watching it. Now let's take a look at ICE ticker. So I do want to actually accumulate this business. I do like this business, and I think that there's worse buys out there, but I want to be patient. I might actually just build a little small watch position, and then this time just keep it. Okay, but I do like this business. I actually should make a video on this one because I think that they'll benefit from a liquidity boom should we kind of emerge out of the liquidity crunch. But yeah. BAM, no, it's not the same thing as BAM, Fuhat. BAM was a long-term hold before, and we sold. I already have a small ICE position. No. Why do you want to sell Intel again fully, Fabio? Well, because I want to get out of semis. I don't want to be involved in semis right now, for the most part. I want to be involved in other parts of the semi chain or semi value chain. Think of more so in line with like KLA or something like that, but also, I want to redeploy capital elsewhere. My real focus this year is really focusing on accumulating real estate, REITs in particular, and that's kind of where I'm at. I'm liking some REITs out there, and that's where the value is, I see. So let's see. What are the risks of money market funds besides opportunity cost, Fed, debt cap risk? So money market funds, there really isn't much unless United States, Armageddon, we default on all our debt. That's really the risk it poses. I wouldn't say there's not, if you're talking about the money market fund, you invest with Charles Schwab or something like that, there's not really risk of capital. You're investing in short duration. So short duration is not going to be very sensitive to interest rates. Where you want to be very careful for duration risk is, those preferreds that we were just talking about, Armando. If you're buying, bonds, long duration bonds in any capacity, especially on the higher quality end of the curve, investment grade and such, higher the investment grade, probably the more sensitive it's going to be to trade exposure. High yield bonds aren't going to be as sensitive, but you're in the high yield category. So, you're taking on credit risk more so than interest rate risk, which is kind of what we're talking about with for example, the credit card business versus something like First Republic that had very high quality loans on the books. And so those loans that First Republic held were very high quality, very low interest rate, very sensitive to changes in interest rate, and therefore all those unrealized losses on the books. So yeah, that's the the thing you're kind of switching up. Good to see you back. Hey Jason, how you doing? There are some that are pure government bonds and such that are purely corporate bonds besides the duration risk. So yeah, you have that, but with the corporate bonds, they're typically investing in high quality ones, so it's fine. Lamb Research is another one, Ricky, absolutely. The PP Money Market Fund. Let's take a look at PP. Okay, because real quick, this has been highly requested in the community. And I know why. It's because we love to have fun and joke around. So as much as like we are also very serious, we do a lot of like joking around with each other, which I love because it keeps it very fun. And like when we do the late night, which we had a late night hangout session last night. I don't know how long people were on there for. I think it was like from the beginning, like probably 8 hours. And then I don't know how long everyone stayed last night, but I went to sleep at some point. So we'll look at PP because I think I was spammed in the request for PP. And I need to probably do a video on it because of how much it was requested. So let's look at the holdings, for example. So meet Kevin, pricing, power ETF, and then we'll go to the all right, here we go. So daily performance, net assets, NAV, 21.33. So NAV, net assets, 21.33 million. Very good for you, Kevin. Oh my gosh, he's making a 0.77% on 21.33 million. Who knows? Maybe it's he's gonna make a ton of money. Look at that. Shares outstanding, all that jazz, and he's making almost 1% from it. That's great for you. Okay, so let's where are the holdings? Physical one, Q1 holdings. Let's go here. Okay, so we have. Let's take a look at this. All right, so Tesla. Ooh, that's a big value there off of a 22 million. Was it 22 or 24? Let me real quick check. 21. Okay, 21. Yeah, so that's a decent chunk right there. Apple, so vanilla. This is Apple right now has become the classic like GE or IBM. Like no one's gonna fire you for owning Apple, right? Kind of stock. Okay, we did have a question come in. Hold on, let me see this. All right, Jason, you're back. All right. So I use famous money market Vanguard. Does a stock being 36% of your portfolio scare you in the sense of we've seen companies like Meta in the past dump 40% after earnings before you can act, can wipe your portfolio gains? It could wipe my portfolio gains. Absolutely. I've made other, gains. Like Meta isn't all of the gains that we've experienced, but it's now like I'd say relatively sizable chunk. Absolutely. So, because like it's not like for example financial education to Jeremy, right? It didn't go up like 1,000-something% where it made all of the gains, right? There were other positions that we cycled out of. If you go back through the portfolio updates, you can see kind of the positions that did well, we cycled out. Another position did well, we cycled out. I'd say that right now at this point, though, I think, since it's kind of more or less at fair value, I might start, doing some things to protect myself, such as purchase put options, actually for the purpose of using them, right? So giving up some of the current gains that I have in an effort to protect the lion's share of the gains, right? Because that's what they're for, by the way, okay? If you guys are wondering, what are these put options for, right? Well, you could use them to speculate on the downward movement of a stock. You could do that. Or you could use them kind of what they're meant to be used for, which is actually to be used, right? So that you say, I have a very large position in X stock. I want to mitigate the volatility in my portfolio so I can purchase an insurance policy against the position, and I can secure a buyer for my portfolio or for my position at X price and at certain date in the future. And yes, I'll give up some of the gains, and maybe I don't even need to use it, but at least it keeps me like peace of mind. So I could decide to do that and do something that is like, just further out into the future where it's long-term capital gains. And then, I can sleep well at night knowing that, I gave up X%, because I don't really know what the prices are for puts right now. But I secured over 100% in gains, right? So I could do that, right? And, Tesla's going to crash. Okay, so we're back to this, but Tesla's going to crash 70%, and that's when retail is going to say it's a buy, LOL. Okay, well, we'll see what retail says there. But yeah, Tesla is a huge part of this portfolio. Absolutely wild. But to be expected. By the way, I just want to state the obvious here that I hope that retail doesn't, buy too much into this. I mean, like the manager here isn't really Kevin, but Kevin being the inspiration, he has a history of underperformance and a strong underperformance, right? This is a guy who turned 40 million to about 10 million around there. I don't know the exact numbers, but we know that at one point his portfolio was valued at 40 million. Then we know at one point it was valued at 20 million. And then at that point, he sold everything, went all into a particular stock, and then also continued to collapse. And then he had to sell for his various business endeavors. So the estimation is that it's definitely fallen a lot from 40 million. So imagine, just selling all that all those courses, all that course money. And you're so, I don't know, degenerate with your money that you just do it all away. I love the words of Anthony Deaton where he says it's very easy to make money and it's like a whole other thing to keep money, right? I love that statement because it's true. It's actually quite easy to produce money, especially it's like a snowball effect too, like especially after you've done it before. And if you get marketable skills and all that, and then what's a whole other thing to keep it, which is where, there's some actual, let's say, careers that are made out of just catering to very wealthy people on keeping money. And that's something I think, some people don't really quite grasp. Once you get to like a certain, I guess, level, I'm not there yet, by the way, but once you get to like a certain level, there comes like a point where you're far more concerned about preserving than you are about gaining. And then you might say like, okay, but why are you going to this fund that the performance just isn't that good? Well, it's because they advertise something that rings very attractive to that person, which is low volatility. So yeah, anyways, we're not talking about that. But yeah, let's see. Autodesk. He has a position in Autodesk, Advanced Micro Devices, ASML, Intel, NVIDIA. So he has a decent exposure too. So about 3.5 million, let's call it, in semis there. Very vanilla exposure, like basically all the names that retail would know of. Etsy, a lot of these are retail stocks. Enphase, which is retail and institutional. Solar Edge, from my knowledge, the shittier version of Enphase. Generac, I like Generac. Hey, actually, Generac you might have bought at a perfect time. We talked about Generac. GENC, I think it is. No. GRNC. No, what is it? I'm just gonna type it. GNRC. Oh, I was close. All right, so. No. They come back down. But I think, okay, just off the cuff, I think Generac's at a decent valuation, by the way. So I'm not like saying it's a buy, not financial advice or anything like that, but I think it's actually it looks pretty good here. I ran it through some analysis already, and it looks pretty good. So doesn't mean it's going to do well, but it looks pretty good. So the prospects for Generac, because we're on Generac, I don't want to just leave you guys right there, but prospects for Generac is their expansion into Europe and all that, as well as the continued, let's say, in directional growth in their American business, natural disasters being one of them, where if people are more concerned about natural disasters, that does expand the demand for what they currently have in the United States. So like, power outages in Texas. Generac, there you go. Hurricanes in Florida or Puerto Rico. There you go. So those events drive the demand for their products. In Europe, energy insecurity can drive demand for their products, et cetera. So Generac, in that space, has done amazing things. There are other players too, but Generac is like a pure play exposure to this. So pretty good overall. Apple, I already talked about that one. But yeah, it's just very vanilla, some of these. And honestly, there's absolutely no reason why, if you want some sort of like higher tech exposure, just go with like something like QQQ. You'll pay a lower expense ratio. You'll get exposure to you'll get exposure, I think, more broadly to a much more diversified portfolio of tech-based businesses, innovative businesses, et cetera. I do say I kind of prefer this portfolio, though, over Cathie Wood's because Tesla exposure is muted, right? I mean, no, that's not muted. It's heavy there, but at the same time, you do get some alternative investments here. Not like literal alternative investments, but alternative for those guys, like in the sense of like, you got, I think Autodesk she might have as well. I forget. I really do forget her portfolio. Oh, he also has Taiwan Semiconductor in there. So anyways, this portfolio kind of lives and dies by Tesla at the same time. So PB's best position have the lowest allocation. Autodesk and Generac the GOAT. Yeah, you should call them up and say, hey, give me a percentage. Up and the right as Kingdom prefers. Oh, dang, that's a dig on you, Kingdom. Armando. Up and to the right. Well, I get it. Too late. It was already tornado weather yesterday. Encore Wire could be a good shout for indictment weather stonk play. Oh, Encore Wire. Oh, okay, that one's good. But they are cyclical. Yeah, the thing with cyclical businesses, they're a little bit more difficult to analyze. You know that, Julius. But I'm saying for everyone else, like they're like one that is a fantastic business, by the way, is Thor Industries. So Thor is really well run, but it's in one of the most cyclical businesses you can possibly be a part of, selling RV homes. But I'll tell you, hey, it's a business that Buffett is a big player in. I think they're the second largest player in this. Oh, they actually came down. So let me see. Yeah, they came back down. So this is quite nice. I might look at accumulating this one a little bit. I've held it before and, just want to maybe get some in here. But I got to do my research. But I'm just like looking at the price and going, oh, okay, it came back down. Because what happened with Thor is they had a huge super cycle, right? Now let me actually show you the longer term trends to kind of show you. But really, this is like more indicative of like further along their cycle. This whole trend of like, oh, we're gonna travel and all that jazz, blah 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 blah. Well, yeah, Thor, very boring business. You're not really gonna get much excitement out of it, and they are vertically integrating a lot. So one thing I'll say is that P ratio is very deceiving. So you see that P ratio 5.45, and retail will like foam at the mouth. What you want to be very careful of is that PE is actually going to rise, elevate, not because the price is going to go up, but because earnings are going to come down a lot. They have really tough comps coming, and I think December's inventory numbers, and this is actually something that I talked about for 100% certain. I talked about this in the macro live streams. But they were down like 50%. Okay. So if you were buying over here and you're down now to like, if you were close to $92, which, let's go for like this plateau area, down 14%. It's not crazy, but like you're down 14%. You're like, oh, why? It's a 5 PE ratio. It's super cheap. Why is it going down? Yeah, it's because, you didn't really pay attention to that. All right, so what about housing stocks? Great sector. Oh my gosh, what a controversial sector that one is. So housing stocks have basically said recession. What recession? That thing, the people making less money, people not being able to buy as much house. Nah, that's not happening. So market, it's kind of almost saying in this pocket. Let's pull up. What's a good one? I don't know, Toll Brothers. Let's pull up Toll Brothers. So Toll Brothers, $63.91. So it's pulling up high, low PE. Again, I'd almost be very cautious about that, right? It looks cheap. It's going to go up more because it should be at like a 10 PE or something, or 9 or 8 PE. Multiple expansion. Be very careful about that, right? While market's kind of getting really excited here, I'd more or less be more on the cautious side of this rally for housing. But so Chen and MD, very good question. So for me, I'd be kind of looking at outlook for the suppliers to this. One of these guys that you want to maybe listen in on is BLDR, get an idea for how they're thinking. And I think they're pushing all-time highs as well by extension. Yep, all-time highs by extension of their end-based customers. The best builder that if I could get at a fantastic price, I'll just shout them out, is NVR. You should know them or at least put them on your radar. You want a great example. Oh yeah, Lumbar's another good one to look at, so you already know that. But NVR's one of the best businesses in this space. Actually, I think the best business in this space. Fantastic capital allocators and has been one of the best performing stocks in this entire sector. So if I show you, for example, the max chart. So congratulations to anyone who might have held it over here. Congratulations. Very, very well done. Let me show you kind of the return since then. Yeah. Bask in the glory. But yeah, NVR's management team, their strategy, the way they have changed their business model over time, they deserve a higher premium. Again, so that's a premium in this space, by the way. So that same is true for this one as it is for the other ones. A 12 PE is a premium in this space, considering cyclicality, the scarring nature of it. Now, there are arguments on the bullish side of home builders saying, hey, we've been underbuilding in the United States and Canada for quite some time. Because we underbuilt, they have so much demand. They have so much demand that they can keep building and building and building, and people will keep buying, right? That's the narrative, and I can see that. I agree with that. I agree that the arguments are there, and they make a lot of sense. My weariness here is getting exposed now, and what was really unfortunate, if you guys go back to the live stream back in November, I was saying that I was looking in here. I was looking in this space. And then, and this is post my criticisms of like Ross Gerber, which were early 2022. The Peter Schiff versus Ross Gerber debate, where Ross Gerber said he was getting really heavy into home builders. Go check out the video. That's the beauty of YouTube. My words are vlogged, right? So, and I got a comment on there saying that Peter Schiff was right about everything, which I disagree, by the way, but just reminds me that that video exists because I have like 400 videos now. But anyways, so in there, I kind of criticized Ross Gerber's opinion on it because I think he was wrong, that at that point, you were getting a really good cheap deal on home builders and such. And even though, I think the video is somewhere in February, so I'll just go from here, whatever. And this is not even, he was investing in not NVR. NVR is high quality. He was investing in like sub quality, which is like Lennar. So I'll show you Lennar if we're using this as the example. So February-ish, like around there. So it would be up like, 24%, which is not bad. But the part where I was looking at home builders, and the home builders I mentioned in the live stream were, NVR was one of them, but the other one that I was really looking at was, I think MTH, a more distressed, smaller one. Not distressed, that's actually a really bad thing. They weren't distressed. But yeah, November-ish time was when I was looking at MTH, and yeah, it's rallied like 60%. Because I ended up not buying it, and there was one pitch, small pitch, it wasn't like a full pitch, for, gosh, now I forgot their name because I almost like didn't want to look at them anymore. The UK home builder. If someone can remind me the ticker, you guys will get to it faster than me. But the UK home builder I was pitching, that one I think rallied a lot too. No, it was not. It was not that ticker, Julius. That's a funny one though. I think it was DR Horton too. I don't think it was. No, I didn't pitch DR Horton. Or I wasn't even looking at DR Horton. But yeah. So Shiv was right about more than Gerber. LOL. Yeah, he was. Tim Hortons. Oh, Tim Hortons. Oh, classic. All right. But yeah. I'll kind of come back to this if someone reminds me the ticker. But yeah, the point was I was looking at them because there was a part that the valuations were starting to get, quite interesting, where pessimism was peaking. But now I'm not even interested. Now I'm looking elsewhere. But good question that you brought up with home builders and such. I think that, don't dismiss them entirely. Just keep them on your radar and just watch. Just watch, right? And then if you find one that you like and you want to build a position in it, there you go. Look at QSR, bro. Oh, I will. All right, so QSR, because they no longer have involvement from that company I despise. So I would actually consider them. Don't tell me they've like rallied to Kingdom Come. Oh no, they haven't rallied to Kingdom Come. They're just like up, but they're not like all-time highs and such. So they're not. Well, actually, they're not too far away from all-time highs. So what was our low point here? June. Yeah. Well, there's 46% movement there. But yeah, this one arguably now should be at a relative premium for the business they're in. The whole sector, this specific sector, trades at a premium, especially in the restaurant space. So like think McDonald's, Wendy's, and all them. So they trade at a premium because what they are involved in is the franchise side of the restaurant. So they generate royalties, they generate percent of revenue streams. So they're pretty much secure, a lot more secure than the restaurant themselves. They're very different from the, when we think about like your local small restaurant. So the brands that they have, some of them are very mismanaged. I'm thinking Burger King, but they have Tim Hortons, they have Firehouse Subs, they have KFC. There's one more I think in there. But no, they have some good brands. Like, and by the way, Burger King in the United States is bad, but like it's good in other countries. For example, if you go to Spain, I think in Spain Burger King is preferred over McDonald's, but in the United States, McDonald's is preferred over Burger King. Because have you ever been to a Burger King here? It's really bad. It's really, really bad. So, oh, you meant Gerber buying DR Horton? Oh, okay. Thank you, Julie. I didn't understand at the time. QSR is trash, Burger King is trash. Yeah, I get that sentiment, Chen MD, but there's always a chance they could turn that franchise around. But yeah, you're right. So I want to show, for example, QSR's relative multiple compared to, for example, Yum Brands, right? Yum Brands, which trades at a relative premium to them because the brands that they have are managed much better. I think Taco Bell, you have Pizza Hut. Sorry, I said KFC for the other guys. These guys are KFC. The other guys are Popeyes. Sorry, reverse. Honest mistake there. But so these guys are the KFC guys, and the other guys are Popeyes. But yeah, Yum Brands trades at a relative premium, and then they kind of trade in line with McDonald's. I think MCD is at a slight premium to them, which makes sense. Yeah, very small premium to them. But these guys trade a premium to restaurant brands, and restaurant brands deserves to trade at a discount. Okay, deserves to trade at a discount. Now, what you have going on for you here is because they trade at a relative discount, if the whole sector kind of gets dragged down, you still will see them get dragged down. Maybe the sensitivity won't be as much, but where things are at right now, there's maybe the potential that they turn things around and then the market assigns them a premium equal to the rest of to the top players of the sector. That could happen, and that might be what Bill Ackman is betting on, right? So not only is there going to be growth or something like that, but they can maybe improve margins, et cetera, improve return on capital, and then get assigned a higher premium. They're already at a premium relative to market, but premium in the sector. So that could be the play there. I love Burger King, like how KFC is better everywhere else than the US. LOL. Yeah, I heard that too. David Koba, where are you in the world? Are you in the United States? Because if you are, maybe it's just like your state or something, because I don't know. Like every Burger King I've been to, which I haven't been in because of how scarred I was for you know what? Maybe I should go again just to see for myself. But I haven't been there in what I want to say a decade. To Burger King, I think a decade. But yeah, Costco pizza and hot dog. Yeah, Costco, man, Costco food. So one thing I want to shout out is, have you guys spotted Walmart? So Walmart recovered strong, guys. I don't know if you guys saw this, but from the lows here, right? It recovered 27%. So it's basically back to all-time highs. Are you in Hawaii? Maybe Burger King in Hawaii is great. And by the way, I'm a little jealous of you that you live on a beautiful island. I know the cost of living there is expensive and all that jazz. I know that. I get it. But still, kind of cool. I heard there's something about living on an island. You get that feeling oh, it's really small and I'm surrounded by water. I forget what that's called. There's a word for that. But yeah, I have no complaints with Burger King, Texas. All right, I got to go try out a Burger King or something, because not for experimental purposes. Jeremy level research. I go to the Burger King, I see, there's a lot of people here. And then I start pitching. I go guys, I found my next Tesla. I went to the Burger King. I take pictures of people. I like just walk up to people and just snap a photo. Flash on, by the way. Flash on. I go up to people, take a picture of them eating a burger. Maybe I help them out, grab a fry, help feed them a little bit and say ask them questions, bother them, and then come back with that research and just tell you guys. And I film the whole thing. That's like the video. And then maybe we do that we do it like a channel check and all the subscribers in the Discord, they all go out to Burger King's, do the exact same thing, become a menace to society. Anyways, Jeremy level research for the win. Yeah, no, absolutely. That's how you win. That's how you beat the market. You just do Jeremy research. He should make a book about that, right? How to beat the market. And in there he should describe going and following people on, the grocery store and tattooed chef and making sure, and then maybe sneaking a tattooed chef in their basket. All right. Anyways, and then you invite them to the trucks. That truck stop company got acquired. So yeah, but you need to do a strongman Jeremy. I can't. Hello, everybody. Oh, I'm Jeremy LaFay. I can't do it. It's something else. What were the price targets on the Sony episode? Your screen blocked the sheet. LOL. So Sony price targets were like 70 is 60, like between 70 and $60 a share. That was the price target. So I think my commentary was talking about it, but Sony was just there, right? So now it's not there, but Sony was just there. So had I done the analysis earlier, unfortunately, it really sucks because I pushed off Sony for so long. And I'm dealing with relatively the same numbers, right? So the analysis would have come up with a similar price points, which is really unfortunate. But that was the price ranges and higher, basically higher probability on the 70-ish because the bearish cases were the 60s. So now that it's appreciated a lot, I would for my investing style, I wouldn't be accumulating, but it was literally just there. So it's crazy how opportunities can close. 69.69 is a good middle ground for that, but yeah, that voice is great. LMAO. I just look at the forward PE and revenue. That's the way to do it. Investing is that easy. Just forward PE, revenue growth, boom, done. What Caesar said, just tell everyone it's $69. Yeah, okay, it's $69. That's a relatively healthy middle ground between where it was. Exit price for Sony is $420 and $69. Yeah, yeah, for sure. But yeah, that's Sony was a good business. It was a good business, right? But look at Bandai Namco Holdings. I'll look at it. I'll pull it here on the side just in case. All right, let's pull this guy up. Okay, where are you at? Oh, it's in Japan. All right. No, it's fine. I thought it's not a nano cap. Yeah, no, that's what I was checking. And then it's not a nano cap. All right, let's take a look at this guy. So performance has been pretty strong. All right, so it has been public, at least in this market, for that long. It's on the over-the-counter. Bandai Namco Holdings is in Japan, and Bandai Namco Holding, also known as Bandai Namco Group. Generally, Bandai Namco is a Japanese multinational holding company. Okay, so we're going to be dealing with basically some of the parts valuation, kind of getting an idea for this value. Specializes in toys, video games, arcades, anime, restaurants. Jeez, man, why do they do so much? Japan loves these conglomerate businesses. All right, let's, I'm going to not even play around. Let's go to English. Company information, business, IR investor information. Let's go here and keep it in English. There we go. Supplementary presentation materials. Let's go with the presentation material. Oh, gosh, I don't understand. No. Oh, what? Gundam? They're Gundam? Oh, okay, look at that. So, Bandai Namco. All right, so honestly, let me see. The number should be legible, right? Because yeah, okay. So I just don't know what this is. Unfortunately, I do not speak Japanese. I am illiterate when it comes to Japanese. So I look at numbers. Okay, so that means it's good because it's a plus. So that means it increased. That's 2021. Okay, I understand this. This is 2021. I assume that's revenue, right? It's probably sales and it goes down, it would make sense. They got all the Dragon Ball games. Okay, so I'll say this, right? Let me go to their earnings report, and oh no, yeah, it's in, because the thing is their line items are going to be in Japanese, and so I'm going to kind of go off of guesses here because yeah, this is not going to be good. This is going to be no, this Japanese is Japanese GAAP. All right, delta. There's not really much I can read from that. Let's see, presentation, question answer session. That's not going to be good for me. Quarterly report. Yeah, it's not going to be good. All right, so I'm going to use a third-party website real quick to kind of handle this. All right, so we're going to use this. All right, so, all right, we're going to, give me a second on the patient. Thank you for your patience, everyone, while I gather this. Okay, so we're going to put this in. Oh, we're going to talk about Schwab. Good question, Ricky. So I'll talk about Schwab. Bro, this is hilarious. Yeah, no, I was trying to find it. Like, okay, how can I do this? All right, by the way, everything's from latest on the left. So the left-hand side is the latest number. So we're taking a look at the income statement. Income statement, you can see strong growth across the board for the past 10 years. And then gross profit margins are actually coming in pretty strong. That's nearly 50% gross margins. That's pretty good. Operating income also pretty strong off of revenue. So operating margins are good. Net income's also pretty good. So right down the line item, there's not really much in terms of interest expense. Makes sense. Before I even look at the debt, I'm going to assume the debt is, or I'm going to think the debt is pretty low. And the cost of capital or interest rates over there in Japan being so low, it actually helps them out. We have some question about Japanese conglomerate. Okay, so speaking of Japanese companies a lot lately, what are your thoughts on Japan's shrinking population? Does that impact the future of many of these Japanese conglomerates? No, because a lot of the Japanese conglomerates do business outside of Japan. They're international companies. So Sony, while Japan's population is decreasing, and this is, going to be noticed by Sony, they're doing a lot of business globally. So Sony's still going to be doing fine. Nintendo's still going to be doing fine. Toyota's still going to be doing fine. Bandai Namco, they're going to be doing fine. A lot of these conglomerates do business outside of Japan. So I don't think that argument really is like, Japanese population is declining, therefore these companies are dying. Now, that will affect banks within Japan that do banking in Japan. That does affect them. That affects other kind of businesses that are mainly focused in Japan, but not really these other businesses that are, I'd call, more global companies. So a good question, though. That's a very good question, because that is a concern that should be top of mind, especially when we're investing in foreign countries. Or what are the demographics looking? How does that translate over to their stock market, et cetera? So looking at the cash equivalents, 1.8. All right, pretty good, because we're looking at for the debt. And what I not see? Oh, there it is. Okay, long-term debt. Yeah, so my assumption was correct. So very low debt levels here, very stereotypical of Japanese companies. So yeah, looks good on that front. There's nothing really to complain about. Can I look at STLA and USB? I will look at USB because I wanted to talk about USB. STLA, I can take a look at them as well. All right, so this one honestly furthers more research just because I don't have international Japanese holding. And I'd actually love to own one. I'd have to see, for example, what my valuation comes out to, and then if I want to buy it or not. It does look like it's plateaued, and it's kind of running up towards the end right there. But it looks good. I would say that the business they're in is quite attractive. I'd like to maybe think about them because they also do toys, and they have a lot of IP like shows, video games, and all that. Think of them like Hasbro, but maybe better run Hasbro. That is a dig on Hasbro. Because Hasbro's been a poorly run company for a long time. And let me actually pull up their stock price, because this was actually, I'm going to shout out a member of ours that actually talked about Hasbro. And congrats to you, because I think Hasbro did kind of nicely since we were speaking about them. But because it was this recent run up here right there. But longer term story of Hasbro is still like, it's a mismanaged company, right? It's kind of mismanaged, but it should do well. Had other countries seen a bank crisis like here in the United States? Yes. Well, depends. Yeah, the EU is having their own form of it, but Canada doesn't because Canada backstops everything. like their government backstops everything. But that, if you look at the banking systems of a lot of other countries, they're a lot deficient compared to the United States. They don't do what a banking system realistically should be doing. They're not as robust as the United States is in terms of adaptability or decentralization, which allows for a lot of investment in SMB projects. And that helps a lot with growth. And if you don't have that, you don't have a lot of growth in the SMB market. You don't have a lot of growth there. You don't have a lot of economic growth or real economic growth, sustainable economic growth, et cetera, all that jazz, which Germany and the United States have in abundance compared to their peers around or surrounding them. But yeah, let's see. So there was the company such as USB. So this is one that I do want to buy a bit of, just build a position in it. And the reasons why is because, there's some pessimism around it. And I didn't get to talk about this, or I'm now remembering to talk about it. How it relates to real estate. So the commercial real estate side, a lot of these banks have not recorded the losses on their books, right? And so when you're kind of penciling that out into your valuation for banks, well, you got to be very careful. And so good thing that a lot of these banks did report and talk about it. I'll kind of give you the TLDR on them. So US Bank, I think, is like 20-ish%. You had Citizens Bank, which was another 18-20%. You had, what was the other bank? There was like 3 banks that were talking about this specifically. And so the commercial real estate part of their portfolio, which is significant, the CEOs were saying, of course they said this, it's fine, it's mitigated, it's going to be, we're not going to lose everything on that part of our portfolio. But if you really look at it, right, US Bank has historically been one of the best performing banks. And I'm saying, like, when I say best performing, I'm saying they have return on common equity that rivals JP Morgan Chase. So for those of you who don't know, return on common equity, it's not the end all be all. It's not what you should like focus on. It's something you should look at, but it's not something you should focus on. But it's a good way of saying, like, okay, how good is a bank at generating money? Like, how efficient are they? And JP Morgan Chase is the best, like the gold standard, especially at their size. They're just incredible. And then US Bank comes in basically at second place, or matches them on that. But where JP Morgan Chase comes in terms of just being absolute chads in this space is that they've also lowered the duration of their portfolio. So low duration can signify good risk management, right? Because JP Morgan Chase, so previous to this banking crisis, because it's important to talk about, this deserves its own video, like a macro video. I should do a macro video just for this. But prior to this banking crisis, most people were concerned about credit risk, because credit risk was the common problem around 2008. And so since 2008, people have been paying attention to credit risk, and we forgot about liquidity risk. Not everyone forgot about liquidity risk. There were analysts that were concerned about liquidity issues. And in fact, you might have been around the channel to hear the word liquidity crunch. Now, liquidity crunch did not extend from me into like, we're going to have like a banking crisis per se. But I did believe it was going to affect lending. So lending then could lead to recession, et cetera. By extension, like this banking crisis is not caused primarily or directly by the liquidity crunch, but by just people freaking out and withdrawing. But the liquidity crunch causes the banking system to halt, right, in terms of its response. So let's kind of be precise with our language. So being precise with the cause/effect, liquidity crunch didn't cause this. What did cause it is people rushing the bank. But the liquidity crunch is not allowing the banking system to adapt properly to it. And so how does this come about? Well, you guys already know the spiel. You've heard it tons of times now. But when we were going through early stage liquidity crunch last year, banks were beginning to change behavior around July. And I remember that day just because I've repeated it to you guys so many times. So anyone who's new, just repeating it again, but for those who are new, back in July, we saw a plateauing of lending growth. And so that signified just change in behavior right there. We continue to see the change in behavior throughout the rest of the year. And really the change in behavior kind of you can point at the start in February 2021, but it took a while for it to take, I guess, full effect. And if you guys don't remember what happened in February 2021 was the blow up of that hedge fund. So if you kind of want some references of what went on, and that was also the peak of a lot of the meme stocks, right? Or a lot of the YouTube stocks. And so from then on, after that peak, you kind of saw them being the canaries in the coal mine, which if you want to know for like the next time, the next cycle, whatever stocks that are very popular among retail, they tend to be the canaries in the coal mine for when things are starting to, get bad. So those are the ones that will, move or die first. And then, we get into, I guess, the remaining reaction. But anyways, so United States Bank and all these other banks, they had a lot of, well, not US Bank, sorry. A lot of these other banks had duration risk that people weren't paying attention to because the credit risk was phenomenal, including Silicon Valley Bank. Credit risk wasn't really main concern. What ended up being the problem is, your duration risk and not having enough liquidity crunch. So with that being said, JP Morgan Chase has shown to be, again, that they are the best at what they do. And while Bank of America and Wells Fargo have, by the way, a liquidity issue, they're so big that they don't have the people rushing, right? Because there's a sentiment around that there's nothing wrong with them. But mark my words, if we all rush them, that would be a problem. But all of us are not doing that, so they're going to be fine. JP Morgan Chase has both the highest returns on their book and the lowest duration, or among the lowest duration on their book, which is amazing. It's phenomenal. So that's the I guess what we have to admire about them. Now with the other part, and it's not Melvin Capital, by the way. Someone said Melvin Capital, Archegos. It's Archegos is the one that blew up. U.S. Bank is kind of in that, I guess, midpoint, right? They have really good credit, right? They don't have much credit risk, and they don't have much liquidity risk. But, well, actually, they got more on the credit risk right now, and that's kind of the fear. But a little bit also in the duration risk, just because they're getting bundled with everyone else. So this drawdown here, if you buy now, you're basically making the bet here, and that's at the end of the day kind of what it is. So I would mitigate size or positioning, but you are buying historically a very solid bank. Warren Buffett sold completely out of it because I don't think he, from a risk management perspective, it could be very bad. Okay, if you have billions in this business, even though as a percentage it's small, it's still why make that chance? So getting involved with U.S. Bank, you need to understand the risk here. And me highlighting the commercial real estate risk, don't dismiss that, right? Because it could end up being a big problem. I think a lot of people are pointing to it right now as being a big problem. So it's not like a secret. And again, that's why they're priced as such. If it was a big secret, U.S. Bank wouldn't be priced like this. It would have already kind of recovered somewhat, like with some other banks that have already kind of recovered. But I'd say the market is properly pricing in the risk. And so what you're doing here is I don't think you're really making an informed bet against the market somehow, that you're just like, more intelligent than the market. You're kind of just almost saying like, well, I'm going to take the side that it's not that bad. And if it ends up not being bad, you'll be rewarded for that. So just because of that, my involvement will be small, right? Thanks on the credit, thoughts on the credit default swaps. Oh, thank you, by the way, for the super chat. So I'll put up your question here so everyone can see it. And so it should be there. All right, cool. Thoughts on the credit default swaps? Feels like MBS in 2008. Thanks for all the free IQ points. No worries. Okay, so I personally, first of all, to get involved in those products, retail won't be able to get involved in that. But I don't think that's really the issue here, right? I don't think the issue is on the credit side. Again, I think the issue here is on the, oh, well, you know what? No. You're maybe referring to the CRE, commercial real estate. So there, yes, okay, but that's going to be probably already a crowded trade. I would bet that right now there's already a lot of money flooding in that direction. Okay, so because right? We're having all this discussions about VNO that might, default. And in some cases, what they're doing is just literally just handing the keys off to the bank, metaphorically and literally handing the keys off to the bank by defaulting, right? Saying we can't pay the loan. It doesn't make sense. We're walking away from this deal. And that's happening in some markets like New York, San Fran, et cetera. So that's more or less, that's known information. Getting involved in them would have been very interesting tail end of 2022 or mid 2022, when a lot of these office stocks, so let's take a look at, for example, the price action. I kind of almost want to make that bet that if you were getting involved in those instruments around this time, and you had the foresight to see that there was a problem coming along the horizon, you would have made probably a killing, because right now there's probably a lot of money flooding into those products. So for a second there, I thought you were talking about it from other, let's say, credit instances, which I don't think, like, right now the concern is CRE. So CRE is where now it makes sense, but it makes sense for us. It makes sense for them. I foreseen the problem when Realty Income diversified their office holdings. So, okay, Dakota, there you go. So that's actually a really good talking point there, a really good example, right? Realty Income, for those of you who don't know, spun off, and I wanted to take a look at it, right? Because I was like, oh, this looks really cheap. You guys remember maybe my video from 2022, and I ended up not buying this company at all. Because here's the problem with Orion. Okay, so Orion, this is the one that he's referring to, that Dakota is referring to, is the company that Realty Income, ticker symbol O, spun off. So Realty Income bought, I think it's VREIT, something like that. They don't exist anymore because they're now part of Realty Income. And then Realty Income took a look at their total portfolio and decided we want to exit entirely office. And so remember, Realty Income's management is known to be really good at what they do, okay? That's how they got to where they are. That's how the company has also done so well. But they decided they don't want any part of office. And specifically, the office real estate that they had was the type of office you really do not want to own, which is non-A class and single tenant, suburban style. So there was an argument to be made that, there might be a room for a lot of these, offices to have tenants. But really, at the end of the day, what you want to own, especially when things go down in the cycle, because office is very cyclical. By the way, if you didn't know that, office is like the most cyclical real estate, maybe second to only hotels. Hotels is probably the most cyclical. Office is second cyclical. Least cyclical is like cell towers and what else? Like residential. Like those are the least cyclical. So by proxy, not by proxy, by extension, you'll see the premiums, kind of in line as such. So office will usually trade at a cheaper premium. Hotels as well, and then cell towers, et cetera, trade at a higher premium. Anyways, so Orion was spun off from Realty Income, and they had a bit of an issue because a lot of their tenants had their leases coming up. And the thing with single tenant office real estate buildings that are typically focused on maybe headquarter buildings, which is what O&L is focused on, have a crazy amount of CapEx involvement. So when you look at like a really low payout ratio for like something like O&L, which it did, and that was what retail was focused on. Retail was like, hey, low payout ratio, that's super bullish. That's great because they can afford to pay a high dividend. It's very sustainable, blah, 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 blah. Well, caveat or asterisk to that, once the tenant moves out, you got to spend a lot of money to refurbish it, get it ready for the next tenant to move in. So yeah, hold your horses there, but all in all, it was cheap for a reason. And so what Dakota is actually referring to, I can see that argument. I can very much see that argument. So when Realty Income was telling you, hey, we don't want anything to do with this, maybe that was your signal to get involved. So, be on the lookout for something like that. Maybe we learn a lesson from there and kind of be creative with our signals in the future. They could be wrong next time, right? It doesn't mean that they're always going to be right. It could just be they, whatever. But it was something that, in hindsight, now we look back and say, oh, yeah, that makes sense now. They were right about that. Ben Mala type real estate, LOL. Yes, we were talking about that last night in the hangout. If you guys don't know, there's a real estate guru on YouTube and real life called Ben Mala. But he owns a lot of like crummy real estate, right? So I love the feeling of raising the rent on single mothers when they. Oh my gosh! Oh my gosh! Oh, that's funny. Okay, so let's see if there are other questions that came up there, though. Investing Cole was here. Oh, hey, Cole. How you doing? Cole did not answer your question about coming back. Capital Mind said, Julius Caesar, do you have any thoughts on packaging companies? Okay, so great question. So packaging companies also kind of cyclical. In general, and I would stay away from international paper. I like more PKG and GPK. So IP is international paper. This is actually the company that is a lot more favored. Oh, not IPO. Oh my gosh, Google, come on. By retail. The reason why it's favored by retail, if you had to guess, does anyone have any guesses why it is? We'll see if anyone can guess before I give out the answer. And yes, Dakota, Ben Mala is like the king of slumlords. Oh, Julius guessed it. The dividend. So, well, dividends are great and all. They are not the reason why you should invest in a business, right? There are many other reasons. No, not location. That's another good one. That's funny. No, it's not the location. It's a high dividend. So who doesn't like a high dividend, right? Like, you get free money and all that jazz, right? It's not free money, but yeah, high dividend, low PE, does the same thing, right? No. So PKG has a much better capital allocation strategy, historically speaking, than IP. Trades at a premium, lower dividend. I will take this one every day over IP all the time, right? So you're paying up for quality, but like I just said, you're paying up for quality. So I stick to quality. When a sector gets to, this is a good rule of thumb. When a whole sector gets depressed, right? You could try to play like really smart and find that, currently super underpriced, lower quality, but for some reason it's going to become higher quality. That's the key. Oh yeah. That's the research you have to do. So you somehow know that X company is going to all of a sudden become higher quality. And then when the sector recovers, they're going to grow with the sector and then get that premium. That's your true outperformance there. But in general, when a whole sector gets, smashed and destroyed, you kind of want to focus more so on the high quality names. That's where your actual performance is going to be. Why? Okay. Great question, right? Because I know you're wondering, wait, whoa. Why is that? Well, when the whole sector does poorly, maybe something's wrong with the whole sector. Let's start with that. The healthier companies, get this, will take or more likely to take share or come out of it healthier than the ones that are going into it already kind of sucking. I know, crazy idea, right? So that tends to be, it's not like a rule every single time it will happen, et cetera, blah, 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 blah. But it tends to be why you see the higher quality performers actually end up being the better performers out of the cycle than the low quality performer. I know that it's almost counterintuitive to that like not classic, but like that value mindset that people have, like lower PE equals better. No. So like, for example, right? Let's say we have a depression in home builders, okay? Because we were just talking about home builders. And all of them are cheap, but some are cheaper than others, right? So let's say you have just Lennar at PE of 3, right? And let's keep it simple with PEs. Let's assume the PEs are like a good quality measure right now, like they're actually measuring the business performance, et cetera, all that jazz. Good quality PE 3, right? Okay. And then you had NVR at a PE of 4 or 5, okay? I will almost bet that, and let's say Lennar and NVR are going to maintain historical levels of internal performance, like internal business performance. So that being said, and those parameters met, right? Because we're kind of operating in like a laboratory at this point with defined conditions. I will bet that NVR every single time outperforms Lennar on the other side of the cycle, every single time. So your investment, you'll take on less risk, and you'll probably perform better than you will investing in Lennar, despite Lennar just being cheaper. Caveat, or where that becomes different, is if Lennar gets to a internal business performance of that of NVR on the other side of things, and somehow you knew that, then you'll probably perform better in Lennar. But if all else being, or what I just described, it comes true, NVR is probably going to be better. So going to packaging, I will take Packaging Corp of America in a down cycle than I would IP. You'll probably underperform IP in IP. All right, so going back to this one, but that's my thoughts on those. I'll take the other ones over IP. I just mentioned IP as almost like a warning signal, because you see, like, it's nearly half the multiple of PKG, but it deserves it. So yeah. But if you somehow know, or you've done the research, etc., and you figured out that IP is actually doing moves to improve things to kind of get to that same level of quality, that's what we call doing the research, right? So you find that out, and then I change my mind, and then I say, well, IP will be better because they're going to actually improve as a business. And then so if the sector does well, they'll do well, and then they'll do even better as their multiple improves, right? They get multiple appreciation. Okay, so hopefully that gets that point across. I've foreseen Ben, I love the feeling of raising I already read that. I got to catch up. Ben Mala is like, yeah, yes. Okay, so Carrier, we have Carrier, TSLY. Let's do TSLY because those as first. Is this one? Yield Max, Tesla option. Oh, gosh. I love the name, Yield Max. No, that's all I will say. No. Okay, so Carrier Global. Carrier, great business. Really great business, by the way. But I think trades at like relatively fair value. Okay, so could be actually they have some tailwinds, and actually this recent drop off, I got to take a look at them, like a serious look. But they kind of plateaued here for now. But yeah, they plateaued for like this whole year. So what do they peak out at? Yeah, I remember I was around here during this time. By the way, I had the option between them and Otis, and I chose Otis over them. Otis being much higher quality in terms of their income than Carrier, but yeah, Otis has a lot of recurring revenue for their maintenance. Carrier's also a really solid business though. They were just too cheap. So in that case, but they're in a different sector. They're completely different businesses. So what I just said before doesn't apply here, right? Yes, you love Otis, Ricky. I love Otis too. Otis is a great business. You see Otis elevators everywhere, and you just think every time you see an Otis elevator, that's maintenance revenue. That is maintenance revenue right there. It's great. Okay, so I like Carrier. I'd probably take a look at Carrier here, and Carrier's, in terms of like the heavy machinery or HVAC in this case, to be more specific. Looks good. Their competitors are a lot more bloated, and so to get exposure elsewhere, you got to buy these conglomerates. While Carrier, you're really focused. So no, I like Carrier. I think Carrier is really well managed as well. But I'd pick it up on any weakness here. Thank you for giving us the other tickers. Actually, JCI. I forget their name always. Johnson Controls International PLC. This is the British one. I know that. American Irish. Okay, American Irish, not British. Ooh, just pissed people off right there. Now people are gonna come after me. So trades at a relative premium if that PE ratio is to be believed. Dividend yield is actually higher. Let me actually investigate a little bit more. Okay, so let's kind of go here. Okay, so let's pull up. It's not going to be the best. So what was the two tickers? It was GCR TT. Okay, TT. Okay, I got everyone here actually. All right, so just like a quick rundown, like super quick. I'm just gonna, this is not gonna be the most accurate way of doing this, by the way. I hope everyone knows that. So balance sheet between the three, carrier looks like it's the best. Or no, actually, no, that's about the same because it's 3.3 off of 8.7. That's 1.2 off of 3.7. So carrier and TT take it up on the balance sheet. On total debt, it's a little bit of a difference. No, it's about the same. Okay, so just real quick, coming up to the, looks like on these measures, carrier is coming in ahead, but I'd have to recalculate these. I wouldn't trust them entirely. Gross profit margins, carrier's coming in the weakest. Do they make it up for it in operating? Pretty much no. Well, JCI falls behind. And then let's see here, return on total capital. Again, I'd recalculate all this, but TT actually comes out ahead. So TT over here looks a bit more interesting because it looks like they're on the better side of balance sheet, so they're kind of in line with carrier. JCI is a bit more leveraged, and it looks like carrier and TT are coming out ahead of JCI on internal return rates. So yeah. Carrier, thank you for saying that, JC. So Carrier's balance sheet is not factoring in their recent acquisition. So you see, that's where the true research comes in, when you're making sure you know everything that's recently happened. Because remember, quarterly reports are only every quarter, so you got to keep that in mind. So it's probably even higher. So that would make TT, if they didn't do any acquisition of similar size or anything like that, the more conservative of the bunch. And as such, you can see, while Carrier only returned 8% in the past year, you do have Train Technologies PLC that did return 27%. So market has rewarded it. And knowing what we know now, we are seeing pretty strong measures, internal measures, to say, well, this business, but surface level, is doing good. Okay, it's doing good. And just real quick, I was going to assume dividend growth is probably there. There it is, strong dividend growth, 5-year average CAGR of 9.54%. And maybe I should spend some time here. But yeah, so TT, by the way, it looks like it's my favorite, right? It's my favorite of the ones you showed us. All right. Dakota, thank you again for the super chat. I'll definitely take a look at your stock now. Here we go. So can you look SNDL? Wondering if you see what I do. Okay, let's take a look at it. So let me see is this Sunlight Financial? No, it's not. Is it? SNDL. Okay, well, for one, it's a small little company. Just wondering why this isn't telling me. What the heck is this? Okay, so is this the right ticker? Cheap stock, it's garbage, LOL. Earnings, though, and acquisitions. Okay, so why is their website just not working? Is that normal? Unfortunately, yes, it is. LOL. Wow. Okay, so that's their website. Sundial. All right, so let's Sundial, SNDL, quarterly report date. Okay, let's see if I can find. Wow, it doesn't even come up on them. Oh wow, this website is interesting. It's the NASDAQ. Yeah, so this is them. All right, so we got here. No, I found it. You gotta almost like Google it. It just doesn't take you there directly. So this is them, and so this is Sundial, SNDL. Let's take a look at their earnings presentation. This is them. This is NASDAQ traded SNDL, retail stores, indoor cultivation. Okay, so they are a MJ business. Okay, so they have a tax pool, debt. They have no debt, enterprise value, 534. Okay, so I already see what you're probably seeing there. Because market cap, what was that market cap at? They're trading at an extremely below. I have to see what their current quarter states because that's an outdated slide deck. Wait, that's Walmart. Where did I put Sundial? 388 million. And zero debt, probably the same. Let me close all this so I don't have all this stuff open. You know what? Let's just go to their quarterly reports, SEC filings, 20F. So they're in Canada. Okay, so Canadian stock. That's why they're, it's classic. It's all Canadian companies. Oh, I should have used the hyperlink. What am I doing? Just gonna scroll down until I find it. There's hyperlinks right here to make it easy. Reasons for the offer proceeds. No. I don't care about this. Am I blind? I think I'm blind. Key information. I'm so blind. Operating results. Holders. Statements. No, where is it at? Where's financial statements? Audit committee, financial expert. No. Financial statements. Okay. So I was like, where the heck is this financial statement? Hello? Okay, here we go. IFRS is so weird. They put it like all the way down here. What was item 8? Wait, I'll come back to this, but what was item 8? Was item 8 it? Was I that blind? No, it wasn't item 8. That's what I'm saying. It wasn't even item 8. It was like, item 8 is, what is this? Financial information. Yeah, consolidated statements and other financial information. Yeah, if I click that, where is it? It's like the other one that's financial statements at the bottom. Yeah, because look at this. It's not even like... All right, we're going back. We're not playing around anymore. It's just a weirdly designed sheet here. Financial statements. Here we go. So we're going back. Already found it. All right, so, oh, I love that. Biological assets. What does that even mean? Biological assets. So note 11 is when they explain. Wait, no, that's not note 11. Note 10. We'll go there. We'll go later. So let's see. Current assets, cash and cash equivalents, 279 million. Restricted cash, 19 million. Marketable securities, 21. Oh, that's down a lot. Cash is down a lot. Prepaid expense, deposits, investments, assets held for sale. I don't know what that is. That's going to be 5C13. Investments in subleases. They got some subleases in there. Long-term deposits, right use assets, all that jazz. Okay, so you got 1.5 billion, call it, in assets there. Liabilities 2.31, so shareholders equity 1.3 billion off of a $300 million market cap. Okay, I get it there. My concern is, right, a lot of these assets, what's the value of them? Like, okay, so inventory value, okay, we'll take their word for it. They can sell it for that. What the heck is biological asset? It's so small, it's immaterial, it's whatever. 22 on accounts receivable, let's assume they get all that. Marketable securities, fine, whatever. That's down a lot. I hope it's not because of value destruction. That would be a note 8. We'd find that in note 8. Yeah, no, that's what I'm saying, JC. This is a 20F. I find them weird. Wait, did I pass the notes? I might have passed the notes. Hold on. No, I didn't pass the notes. I hate going through these things like this. I'm just going to Control F. Okay. Investment revenue loss. Wait, this is kind of maybe what I wanted to see anyways. Investment loss, realized gains. Unrealized loss, note 8. They don't label it note 8. Great. So I have to find it myself. Should be somewhere at the bottom. No, they probably have a hyperlink for notes. It's a thing with 20 Fs. Notes. They have notes. Wait, if I put this, notes. Where's the first mention? No, there's no notes. Oh. Scrolling down, there's no notes. See accompanying notes to the consolidated financial statements. I'm down here, man. Zoom presentation. It's not anywhere close to here. Financial assets. The company applies credit loss. Okay, whatever that. I don't care about that. It's very... I would find it if I had enough time eventually, but this is we're in the middle of a live stream. Minus 750K due to a warehouse fire. There, that'll do it. If I was capping on CRISPR. CRISPR when? Biological assets. Oh, okay, here we go. Well, I'm just curious about, we already passed note 8 apparently. We're on note 10. The company's biological assets consist of cannabis plants in various stages of vegetation. Okay. Yeah, that's a funny way of saying it. All right, where's 8? Here we go. Marketable securities. Balance beginning of year additions. Okay, so during the year and proceeds of nil were received from the depositions of marketable securities and a gain of deposition. Okay, so let's take a look. Change in value recognized in profit or loss. Okay, so they lost 65 million in their marketable securities. So they had 83, they added 3.7 million, then they lost 65 million there. Subsequent December 31st, 2022, the marketable securities held in Valens were subverted to SDNL common shares and subsequently canceled in relation to Valens acquisition. Note 36, the components of the marketable securities are as follows. Equity securities and puts and call options. Okay, whatever, it's barely had any. So essentially, due to whatever happened with Valens there, in note 36, the value was written down by about $65 million. Okay, so my thing with this one is I assume it's like an asset play, like it's really cheap relative to what the value is on the books, like the book value. But, and let me see, what's their it's SNDL. I'm going to use this charting system here. I'm going to assume the book value, whatever the measured book value is, because then I'd have to measure it myself. Yeah. So it looks super cheap. So this is what I was thinking. But I don't really, I mean, I'd almost only value the cash. But even then, like the thing with these kinds of businesses is you got to, when they're a cash burning business, you got to take that into account for what that's going to be like. Let's say that effective book value, I'm making up a word there, but really, I don't know how else to convey that, because we've looked at businesses in the past that had high cash values, and sometimes the cash value was worth more than the business. And you think, oh, that's an easy buy, right? I'm going to get involved with that business. But no, you know, they're going to need that cash. It's not like it's cash that's in excess of what they need for the business. So that makes it a bit problematic when you're using that in your valuation. I'd almost almost discount that cash, because they need that cash for the daily operations. And on top of that, they're burning tons of cash. And I don't think this company's cash flow positive, which if where'd I shove this? So if I go back up through the notes and go to the statement of cash flows, enough. There it is. Yeah. So net change of cash from continuing operations, it's negative. So yeah, we could stop there. So basically, if you have a cash burning business, GAAP net income, not GAAP, IFRS income negative as well. When you put that together, well, the cash value is not, I wouldn't assign it its full value. It's not like they're going to give you that cash value, right? Another business that was kind of like that was Robinhood. Robinhood was, I think the value of the cash was ridiculous in comparison to what the market cap was, but you still had a cash burning brokerage that needed the cash for its daily operations. So it's not like you can just take the cash. If it was like, okay, this is not the Sunday call, doctor. This is just the live stream. But tomorrow we're still doing the Sunday call. So yeah, no, it's all well and good there, but yeah, you want to, that applies, that logic will mostly only apply there. Thanks for confirming. They've been acquiring companies at a huge rate, worried it's to stay alive. Unless legalization happens, I suppose. Yeah, that's the thing though, because so you'd be betting on a business that its destiny is outside of its hands, and that's a problem there. So I wouldn't. For me, these businesses are too difficult, right? There's other ways to play cannabis indirectly, and that's through larger companies who have exposure via, companies they bought. Like, one that's pretty good is Constellation Brands, but you won't get like the full capture of it. So, yeah. Fabio, what? Jason, what's going on? Oh, IIPR. Okay. Yeah. Okay. Yeah, the other one I guess point to you. Oh my gosh, you got punished again. Someone's punishing you. Oh, that's going to become a running joke now at this point. Lawn dart investing. Hey man, if it works out, it works out. Like if it pumps, that's gonna be a good little chunk of change for you. But yeah, IIPR is the other one that the subscriber was actually just mentioning before they got nuked. And that's, this REIT over here, because they get exposure by almost being like a quasi bank for them. And they're absolutely getting crushed right now. So I think for sure the other year, if you were around back then, you would have remembered that, in 2021, people were like, oh my gosh, this is the best REIT. This is like the only REIT that's like forward thinking, etc. Oh, they got exposure to the weed, So yeah, very high yield right now. I don't know what's at. I think it's like at high double digits now, something crazy like that. But yeah, they operate almost like as a quasi bank for the MJ stocks, because the MJ stocks can't get financing in the United States. Which is a bit problematic if you're a business, et cetera, and all that jazz. But yeah, they help out in that regard. They're fulfilling a need. Okay, with that being said, everyone, I think I'm going to close it off here today. I'm going to go cook my dinner, and I will see you guys. Well, I'll see you guys for the Sunday call tomorrow that Doctor was actually mentioning. So, and then the rest of you I'll see on another video or live stream or anything like that. But thank you guys so much for watching, and I will see you guys on the next one. I think we'll do the outro as well, so we'll do that.
Okay.
We'll do it live.
Okay. No.
We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.
Yeah.